Good morning, everyone. I'd like to welcome you to today's Revenue PIR Roundtable. Welcome our participants as well as our observers, both in person and on Zoom. My name is Mary Mazzella. I'm an assistant director here at the FASB. For those of you that don't know me, I joined the FASB right before the revenue standard was issued, so this is a topic near and dear to my heart. It's great to see some familiar faces in the room as well as some new faces, and I'm looking forward to a really great discussion today. We're going to start with introductions. I'm going to hand it over to Lucy and we'll go around the room and then we'll get started.
Thank you, Mary. Lucy Cheng, FASB staff.
Adam Thurman, FASB Fellow.
Luke Kennedy, FASB Postgraduate Technical Assistant.
Richard Gabriel, FASB staff.
Joshua Spiller, FASB Postgraduate Technical Assistant.
Mark Crowley, FinRec Chair.
Bob Yule, ISB member.
Marcia Hunt, FASB.
Tomo Fujimaki, AT&T.
Susan Mercier, Grant Thornton.
Joyce Joseph, FASB.
Alex Zabareco, Ghana Group.
Mike White, RTX.
Sue Cosper, FASB.
Barry Conchiger, Securities Exchange Commission.
Allison Spivey, Ernst & Young.
Rich Jones, FASB Chair.
Melissa Frank, Forvis.
Angela Newell, BDO.
Stacey Harrington, Microsoft.
Christine Bodison, FASB.
David Gonzalez, Moody's.
Jeff Brickman, FASB Investor Liaison.
Steve Rivera, Johnson & Johnson.
Pat Durbin, PwC.
Monique Cole, RSM.
Meredith Kennedy, KPMG.
Good morning, Jim Croker, FASB.
Doug Ewell, Chick-fil-A.
Hillary Salo, FASB Technical Director.
Nellie Debler, FASB Deputy Technical Director.
Jennifer Kimmel, FASB Practice Fellow.
Okay, great. And if we could go to Zoom, maybe we'll start with Fred.
Fred Cannon, FASB. Welcome, everyone.
Sandy.
Good morning, Sandy Kim, Deloitte & Touche.
Eric.
Good morning, Eric West, Amazon.
Chris.
Chris Sackerland, Bank of America.
Brent.
Brent Woodford, Walt Disney Company.
Sarah.
Sarah Madras, PCAOB.
Okay. Jerry.
Jerry Shawver, Baker Tilly, incoming PCC chair.
And then Mark.
Mark Hamill, Assay Research.
And then do we have Stephen? No. Okay. Okay. Sounds good. All right. Just a couple of things about logistics today. Got a pretty big group here and online. So if you want to get in on the discussion, just raise your tent card so that we know that you're interested in getting in. Online, if you could raise your hand on Zoom, and Lucy's going to help me keep track. I think everybody figured out you just hit the button to get in on the discussion. If you're not speaking, please leave your microphone off because the cameras are in tune with the microphones. And also, I'm happy to say we'll be providing CPE credit today for our participants in the room. So as we get towards year end, I'm sure that's a welcome welcome addition to today's roundtable. So now that the logistics are covered, just a couple of things on background. So today's roundtable is part of our post-implementation review process. The overall objective of the PIR is to evaluate whether the standard is achieving its intended objectives. Those objectives are whether it accomplished its stated purpose. We're going to evaluate the costs and benefits of the standard and also gather feedback on the standard setting and the PIR process. The PIR process commenced in 2014, right after the standard was issued, and is expected to wrap up with a final report sometime next year. Today, we plan to share what we've heard thus far in the PIR process. We've got a high-level summary that's included in the handout, and we'd like to receive feedback from the participants on the various aspects of the PIR as we move through the topics. In terms of the agenda, the first two sessions are going to focus on the benefits and the costs that the board expected when setting the standard and how actual experience compared to those expectations. Our third section is going to focus on specific areas of the guidance that stakeholders have told us during PIR have been challenging. And then we'll wrap up with the last two sessions being focused on process, one being on the standard setting process and one being on the PIR process. So with that, I'm going to turn it over to Lucy, who's going to kick us off with the benefits discussion.
Thanks, Mary. Good morning, everyone. So I guess for some of you, benefit might not be your favorite topic out of the 5 topics for today's discussion. But I do hope after today's discussion, you will get assured, encouraged, or at least relieved that the long hours and brain powers you devoted, the numerous internal, external conversations and documentations you put together and accomplished, and the various resources you put to implement Topic 606 are not just a compliance exercise, but are making a meaningful impact in the ecosystem. So going back to 2014, when the board issued the revenue guidance, it expected 3 main benefits. First one is comprehensive framework. Second one is increased comparability. The third one is improved disclosures. So during our PIR process, feedback on Topic 606 overall is positive. So basically, investors generally agreed that Topic 606 provides them with more transparent and useful information, especially through the improved disclosures. Investors also told us that Topic 606 improves consistency and comparability across industries. So I still recall one investor told us that it is now easier to move across sectors because the model was well understood by most analysts. Another investor told us greater comparability is the biggest and most intangible benefit. Having comparability across industries is extremely helpful. It's easier to talk about revenue in a meaningful way and understand how revenue works from company to company. Although benefits are not the main focus during our conversation with preparers and practitioners, but we do hear some benefits that they shared with us. So practitioners told us that Topic 606 provides a better framework, helps take a fresh look at revenue, and is representative of economics. The structure of 5-step model provides more discipline to the process. Some preparers told us that through adopting Topic 606, they had a better understanding of the business operations and worked in a more collaborative way with other departments within their organizations. So now we would like to hear your perspectives on how revenue guidance benefit your work, your entity, and your clients. So with that, we can open up the discussion on questions 1 through 4.
Allison?
Hi there. I'm always happy to get started, so I'll kick it off. From an auditor's perspective, Topic 606 seems to have achieved the objectives set out by the board, at least in my opinion. The comparability across entities has definitely improved. Getting rid of industry sector guidance has made my job a lot easier as a revenue subject matter expert. And in addition, having convergence with IFRS has also been a key feature so that we can talk to all of our clients around the world using the same framework. So I think that's been a significant accomplishment from the standard and certainly seems to align with the objectives that the boards had set out with 606. I will observe certainly from the implementation process from 606, since we are talking about implementation all the way to now, that at the time the standard was implemented, it was a large lift from a number of different parties. And we observed that companies invested a lot of money and a lot of time in working through the accounting rules. And from an accounting firm perspective, it required extensive implementation guides. And even to this day, the technical guides issued by the firms on Topic 606, I think the minimum number of pages that I've seen in a book is about 500. So because it's a principles-based standard, but there are so many different shapes and sizes of revenue contracts, it takes a lot more guidance to actually be able to implement those principles in a consistent manner.
Stacy?
I thought I would kick it off from a preparer's perspective. I would say a couple things. I think it did accomplish what it set out to. As far as I've been working on this, I don't know, 15, 16 years. So it's been a while. I would say the biggest thing for us was the no specific industry guidance going forward, because we have lots of different industries covered, at least at Microsoft. And so we were constantly having to go to different standards and explain to our executives why if you sold a phone, it was different than if you sold software on a phone. So that was super helpful just in being able to explain the guidance. The convergence with IFRS, I think that's one that maybe people don't understand is the great impact, because anyone who has a complex legal entity structure with lots of, hundreds of statutory filings, that was probably the biggest simplification for us as far as terms of cost. So I like to remind people that when we talk about the cost of implementation, that there was a lot of cost of simplification as well. I think elimination of the rules, specifically in the software industry, a lot of the rules were there to I would say they didn't make sense, the rule was. So I think that in general, I'll kind of put term licenses out to the side because I'm going to make a broad statement. I think that the new standard reflects economics better. And I like the principles. I know that there is more guidance. I think people want to make sure they're not doing the wrong thing. And so they're looking for examples and guidance, but I wouldn't ask for any more standard setting. I think principles are really important to be able to apply. So, the other thing I'd add is the disclosure package, I think was a huge improvement. I think it provided consistency. I think I attribute that a lot to the great outreach by the staff throughout the process. I think it had a very balanced approach, specifically on RPO. We actually use that as a way of looking across industries for similar patterns too.
Thanks. Sandy?
Yes. So I would agree generally that the benefits of 606 outweigh the costs. I was glad to get rid of the industry-specific standards and lack of consistency on economically similar arrangements. It's also great to have convergence with IFRS 15. Having said that, I do agree with the write-up and have heard from many software entities that the standard doesn't properly depict the economics of term-based license arrangements. But, and this is a big but, unless investors and preparers are clamoring for change, I would not advocate for making significant changes to the standard. At this point, everyone has adopted and many incurred significant costs to adopt. So I would rather not disrupt practice and see wholesale changes. So I would say that for the most part, the standard achieved the objectives, and I really do appreciate the FASB putting in principles as opposed to rules. After some initial pain, all of the things that Allison described, we are fairly comfortable using judgment and applying those principles. It is hard to apply the guidance in many fact patterns, especially in the tech industry, and when new and complex transactions arise. But I would say by and large, we are able to apply appropriate judgment. In terms of significant changes, it certainly impacted some industries more than others. For those preparers that didn't see material changes but incurred a lot of costs to adopt, I'm sure some of them will have different perspectives on the benefits relative to the costs. And then maybe one additional benefit I'll point out is I really appreciated the transition guidance and the different types of relief that was given, which many did take advantage of. But even if there was optionality on transition, I would say that one of the big benefits is that legacy gap didn't continue for pre-existing contracts. So you had better comparability post-adoption. Thanks.
Thanks, Andy. Doug?
Thanks, Mary. And I'll tack on to some of the preparer feedback that was just shared. I would reiterate the point that elimination of industry guidance and having sort of one framework to go to when doing accounting research as a preparer makes it a lot easier than having to go to 5, 6 different places to do accounting research. And I would also reiterate the point of when you're trying to explain the impacts to organizational leadership, having a centralized framework really helps. I think another benefit is just the 5-step model in general. I think having a very clear contract performance obligation, I think it's easy to just conceptually follow. And I think that's just something that, when you're looking for, yes, there's a lot of judgment that's applied. And certainly when you dig into each of the steps, you can, and we'll talk about a lot of that complexity later in today's discussion, but I think having that framework is really helpful. Sandy mentioned the appreciation for the expedience and the relief. I think that was another big benefit, and something that I would, applaud the FASB for doing, was providing, various expedients and improvements throughout from the initial release of the standard until its final required adoption. As a franchisor, I certainly appreciated some of the principal agent relief, some of the sales and usage-based royalty exemptions. Selfishly, those really helped throughout the process. And then obviously having some transition relief was very helpful. And then maybe the final point that I'd raise as far as just benefits are concerned, I think whenever you have a new standard, and this may be a touchy subject for private companies that have a hard time with new standards just because of the lack of resources, a reality of standard setting and new accounting standards, particularly large ones like lease accounting, revenue recognition, is that it sort of forces you to relook at your contracts and relook at your accounting. I think what we found is that even for areas of GAAP, especially in Rev Rec, that weren't materially changing, as part of doing our impact assessment, we identified some process areas that needed to be tightened up. Probably some areas maybe that maybe we haven't been doing this perfectly correct under even existing GAAP. And so I just think that's maybe an unintended benefit of standard setting that I think is important not to be overlooked. I think that obviously has to be balanced with the cost of adopting a new standard, but certainly it's a benefit.
Yeah, I think that was one of the number one unexpected things we heard, is that just a better understanding of the contracting and what's actually going on and what these terms are and what the process was not on the expected list, but something that came out. So that's helpful context. Steve?
I feel like I'm at a high school reunion here with a lot of the folks back. And Stacy, I'm glad to see you. I haven't seen you in ages, because Stacy and I kind of worked on this in the working group. Look, from a preparer perspective, I have to say the principle-based approach really made a lot of sense. And let me walk down memory lane. But I remember talking to Scott Taub. I mean, during those days under the old rules, on the SAB 101, I'm kind of dating myself here. We deferred everything. The education that we told folks in the old days was, if you're unsure, defer. Right? Price was not fixed or determinable. You had multiple deliverables. All of a sudden, if you didn't have those obligations, everything got deferred into the future. And here we are in a totally different place, thinking about the right to cash. To explain that to somebody is so simple. If you have the right to cash, why can't you recognize revenue? Control has passed. So this is where we got to such a debate in the old days. And again, if you're a product company like a Johnson & Johnson, how do you deliver products having a FOB destination, or this whole issue with insurance, and not be able to recognize revenue because you had the FOB destination or synthetic destination? So this, I would say this standard has really kind of helped companies better understand revenue recognition, understanding the principles when control has passed, right? And recognizing revenue based on the right of cash, a very simple model, easy to explain, easy to someone to say, I got it. And then recognizing that revenue based on probability, which really is kind of the foundation, I think, which made a lot of sense. The other thing I got to put a plug in for, I think it was PK who called me, I think, at midnight, and put an extra, excerpt into the standard on royalty income. And this was a great ad, because it was a situation where a lot of companies had to recognize a contractual asset based on the probability of royalty income that companies were getting. So this was a good example of really kind of keeping the standard the way it is today, recognizing royalty income as sales are achieved. So I thought that was a good ad, because today people don't know what the future state of income would be based on royalties. So I thought that was a good ad. And again, this is the flexibility I think the standard setters think about, hey, when does it make sense? How can you execute something that you're not sure about, especially with royalty income based on future sales? I think this was a great example of cutting minds together to really think about, can we really do this? So contractual assets, which I do understand, the concept, but you got to have good facts to make sure you can actually record an asset based on probability of cash in the future. So again, I think this was well done, and it was a great team effort. I got to tell you, the way the working group worked, I got to give credit to Stacy and others in the room. Mark, there's a lot of folks in this room who really worked. I think on the standard, and there's others in this room. I think it was fantastic teamwork to come together and pull us into a place to make the comparability across all industries, which was great. So thank you.
Angela, that might be a hard one to follow.
It will be. It will be. I will keep it very short. I will just point out that for a firm that audits a large number of private companies, I can't overstate the benefit of actually having a standard, right? We forget sometimes now that it was SAB 101 if you didn't fall into an industry specific piece of literature, and arguing with a private client about whether that applied to them or not was never fun. And so just filling that gap to me is probably the biggest benefit for our client base.
Thanks. Susan?
I too will be quick because I think a number have touched on this. The importance of a principles-based standard that was carved into a 5-step model. So from a different perspective, it's very easy to teach 606, and it's very digestible and for folks to understand and learn 606, which all of us were in the weeds. So, but we can't do it by ourselves. We all had to, we have a vested interest in this profession, and we have teams that have to be brought up to speed in order to help us with the implementation process and the audit, whether you're working at a company at Chick-fil-A in the financial reporting department, or you're at a large firm auditing. Everybody's has a vested interest. So it's not the 815 with 30 pages of scope. It's not the bag of rules that is 718. It is a very digestible 5-step framework that's very easy to teach. And we're even able to teach where the judgments and estimates come in. So yes, it is complicated in certain aspects, but we can tell people this is what's complicated. So raise your hand when you get to that. So I think it's a big win for principles-based standard setting, and hopefully a blueprint for standard setting to come.
Tomo?
Thank you. I echo from a preparer perspective all the benefit that were mentioned. So just I'll add a couple of additional items. One is the significant benefit we see from having a specific guidance on acquisition cost and fulfillment costs. One, it does align guidance application among our competitors, but also it did give us more visibility into the costs that are being incurred. So from an economics perspective, not only do we understand the cost that's being incurred, but we can assess whether those costs are making sense. The other item is because there are more judgment, we are working more closely with the sales folks and the business unit, not only after the contracts are being signed, but during the negotiation. So I think that's an added benefit we see. And third, from a control perspective, I think there's more visibility because of that. And I think there's more transparency from a reporting and control perspective. So I think overall, there was significant benefit to Senate. Thank you.
If we'll go to Zoom, we have Eric.
Sorry, it takes a second to unmute. Thanks. I'd largely reiterate most of what the preparers have said in the room. I just wanted to add on a couple observations. One, I think the disclosures have been very well received by our investors, particularly with respect to the disaggregated revenue disclosures as well as the backlog disclosures. I think the board thought through those requirements very well. And then wanted to offer an observation on the implementation process. I think the TRG process was highly effective in providing relevant guidance. And I think those amendments that were issued as a result of that process were incredibly important. So I would, congratulate the process there for doing that work. I know that the TRG became a bit controversial towards the end. My only observation would be I would encourage the staff and the board to reflect on why that work couldn't have occurred or didn't occur during the second exposure draft. It seems like many of those questions were probably out there, but just weren't surfaced. I don't have a good insight into why that process was delayed, but I think that the process ultimately yielded some good guidance. And I do like the principles base. I am going to poke my finger in the firms, or poke my finger in the eyes of the firm here. I think the firm monographs they've touted, they're over 500 pages. I think they're very dangerous. I think that they take bright lines in certain positions and they effectively become GAAP. I know that the regulators look to those And it becomes very challenging to argue with a firm when they say, but it's in our monograph. And so I don't know, I offer that in suggestion that maybe the FASB should really toe the technical inquiry line and take positions where there's written non-GAAP GAAP out there. Thanks.
Yeah, thanks, Eric. I think, just to respond, I think we'll probably get to more discussion on that when we get to the last topic on the PIR process. And I think the public TRG meetings and all the papers was kind of our effort to try to get some of that out in the public before the firm guides, but I certainly expect we'll probably have some more discussion on that later in the session. So appreciate that feedback. Brent?
So overall, I mean, I think I agree with most of what's being said. I think it's a good document. I think the process was good. I mean, obviously, it's not easy to try to capture, the broad range of complexity in a single document. The thing I disagree with a little bit is it's one thing to say we shouldn't have industry guidance. I don't know that therefore means every industry can somehow be force fit into the same model. And, I think there's different kinds of IP, and, I think our IP is different than a software license. And this gets into exclusivity, and maybe this should be part of one of the other sections, but our investors tell us they would rather we have symbolic and functional IP, and what we hear from investors is the closer that accounting is to cash, the better. And we had no change basically. And so, so there was, if there's no change, is there no benefit, or there was very little cost? I think we had an opportunity maybe to make an improvement that we didn't get to make in our industry. And so I just, I don't think throwing out all industry guidance is always the right thing to do.
Thanks. So we'll move to Mark next. Mark, we haven't heard much about disclosures yet. I think Eric mentioned it, so I'm hoping you're gonna go there for us.
Yeah, I mean, I am software focused in my work for the most part, so it's really interesting to hear the feedback, particularly from people who cover multiple sectors. But within software, the benefit of comparability, I question whether it's had the benefit within software. I actually think it's taken away from comparability for companies that have mixed models. I think it's really a challenge oftentimes to figure out how to make them comparable because of the timing effect that's resulted from 606 on RevRec. And I think it's caused a real kind of focus to move off of the GAAP financials. I think that's what moves the street are the non-GAAP metrics, which create, I think, a whole other set of issues because there's no consistent definition for those metrics that the street focuses on. So it does, as Mary said, I mean, for me, it comes back to disclosure. I think the incremental disclosure that resulted from 606 is good, but I wish there was more of it. And I wish, there were some critical metrics. I don't know if we want to hit those now or later, that particularly within software would help people to kind of decipher what happened in the quarter, which, it seems like disclosure is all over the map right now. I thought it was going to be more consistent when 606 started to roll through, but it seems to be all over the map.
Yep, thanks for that. I think we've got our last topic in the challenges section. We've got a section on disclosure, so hopefully we'll get into that a little bit more.
Great.
Thank you. Pat?
Yeah, just maybe wanted to maybe build on a point that Susan made. A lot of the discussion is sort of focused on the implementation event, if you will, that point in time change. But I think it's probably good we're having this conversation, whatever we are, 6-7 years on from implementation, to really think about the resiliency of the model over time. And I think you kind of made that point in terms of being easy to teach, it's principles based. So I think that idea that, yes, it's going to be hard. Revenue is a critical element of any business, transactions are different, but sort of the ability of the model to, live and survive, have some longevity, I think is an important benefit.
Meredith?
Yeah, so I'll probably just echo a few of the other comments that I thought were really important benefits. One, relative to what Doug mentioned about the contracts and what a principles-based standard does to provide preparers as well as practitioners a better understanding of the contracts. It better reflects the economics. It identifies risks, either process risks or other risks. And I think that's an ongoing benefit. That's not a one-time kind of implementation. It gets, controllership groups closer to the deal making, which I think is a benefit as well. I'd also just reemphasize the convergence with IFRS, what a huge impact that is, and that the board should be really proud of, given the significance of revenue standard to companies and to investors. Having a converged standard was a really big win, and would really advocate to keep those standards as converged as possible.
Alex?
Not to repeat a lot of the previous comments, I agree with many of them, but I'd probably highlight, number one is I find the accounting results a lot more intuitive than they were under the previous standard. And part of this is, working with different clients and advising them on different revenue transactions. It's actually a lot easier to talk with the business people as well, helping understand implications of this or that particular provision in the contract. A couple of other things, though, I'll highlight. One is, this provided a lot of companies an opportunity and maybe an incentive to rethink their internal processes on accounting for revenue and go into the different automation solutions that also probably gave the professional services industry a good incentive to finish those solutions and put additional functionality in order to be able to take advantage or take account of the different 606 requirements. So I think overall, companies are probably have better accounting systems and accounting processes on revenue recognition than they were before 606. And then the other one is from our professional service firm perspective is, with great disclosures now available, it's also actually a lot easier when you have an unusual type of transaction and there may not be exactly too much guidance on that specifically. It's much easier to research in the public company filings and find something similar and see where the practice may be. So made the job in this regard much, much easier as well.
David?
Yeah, I think a lot of the comments have been said, but from the user side, they also do apply, and especially the consistency of the information. I can't highlight this enough. I understand the 5-step process is really helpful, but from our side, we kind of get the answers. But it's really good to be able to go across industries and across gaps and understand how that works. And we do have, nuanced issues with the difference between cash and revenue and some of these things. And I guess the positive side is at least we understand the underlying reason for the delta, even if we can't figure out what is actually going on between the cash and being there. And having this consistency across industries and everywhere is really a big part of simplification for investors. They don't have to do other research. We can move analysts from different teams across industries, across gaps, and have this straight concepts that we can teach on a very high level basis of how this works. And it's a significant improvement. And in preparing for this, I looked at private company financials before this, and I can't say how different they are and how much more information we get. And that is a very good positive from this.
Okay, great. So I think a lot of what we've heard thus far is in line with what we heard in our outreach. The benefits of convergence, a single model, consistency, better controls and processes, better reflection of economics, but maybe we could have hit the mark a little bit better with software. Just before we move on from benefits, just want to see if there's any other final comments. In particular, just if there's anything, I think the one we didn't get too deep on is disclosures, if there's anything additional on disclosures in terms of those benefits. I think we've hit pretty deep on everything else. So any final comments from participants or from board members or from my team before we move on to the costs? Doug?
Just a quick plug for the disclosures. I appreciate the relief given to private companies. And I thought the last comment was interesting on the private company financials, even with the relief given, are still giving users better information than they got before. So I think that's a win-win, right? Users get better information. Private companies don't have to do all of the disaggregation and stuff that public companies have to do. So I would reiterate that.
Okay, great. David?
Just to be clear, we'd like that.
but no.
Yep, Jim?
Just quickly on whether it's a benefit or an unintended consequence, I always struggle with, and we've heard it on a lot of standards, that entities go in, adopt, and they improve their processes or their decision making. And I've always viewed that, I would hate for the FASB to start getting in a position to say, well, one of the intended consequences or benefits of the standard is you're going to manage your business better. It might be an unintended consequence, but I would be interested if people think we ought to start articulating those things as a benefit versus, I mean, that's up to you all to do whether we issue a standard or not.
Meredith?
Yeah, I would say the way I think about it is it's not that you're writing a standard for that specific benefit, but because the standard was written in a principles-based way that really gets at the understanding of the nature of the promise and it's not kind of rules-based, that is a result that you get. So it's an output of the nature of the standard and its principles-based approach.
Stacy?
I think it's a good comment you made, Jim. And I would just add, we have never allowed accounting to dictate the way we manage our business. It just, how big is the delta between explaining the business in a way, then you're saying, I'm sorry, this is just the way accounting says you have to do it. So I think that delta got a lot smaller, but I don't think we allowed that to change the way we manage business. I would say if you're hearing from accountants, I think the enjoyment level is much higher when you actually get to understand that the business allows you to come in and understand it more. So I think it's more fulfilling, but I'm not sure that we would actually say it changes the way in which we manage business.
Yep, Brett?
Yeah, it's a great point, Jim. I would say this, the more that it's obvious that the accounting aligns with the economics, the better it works, because we always start with what are the underlying economics. And if the accounting lines up with the underlying economics, it's an easy discussion to have internally. But if it doesn't, you're in the position that Stacy just mentioned, which is, hey, we know the economics are this, but the rules say that. And so we always try to understand the underlying economics. And if we can tell our people this is why the accounting works, it's an easy discussion, actually.
Steve?
Jim, Steve, I thought that's a great comment. And what I would say is, I'm going back to the old days. I mean, companies were deferring revenue over multiple periods. And to me, to the point, it was like, it didn't even make sense. And it wasn't about business. It was like the product has already been delivered, but yet we still had to defer revenue into the future. And it almost got to a point where that became the business model. Almost that they used that deferral as almost like kind of like bleeding back into the P&L, which made no sense. So I think we're so much in a better place. As Brett said, the economics will closely more aligned to what's actually going on in the transaction. And again, I think trying to explain it to an investor of why that deferral is out there for such a long period of time, it was really difficult. And so I think we're definitely in a better place. But I do believe your comment is really right on point. And I think we got to think about that going forward to make sure that it is closer so that we can easily explain it.
Angela?
Yeah, I actually might flip Jen's comment on its head maybe and say that, no, I think in a positive way. Like, I think the reality isn't so much that the better standard caused companies to manage their business differently. I think bad standards with bright lines sometimes can cause companies to tailor their business to try to achieve an accounting outcome, right? And so it's not that the intent necessarily is to change business, it's to get that the accounting more closely aligned with the economics so that companies aren't incentivized to try to play games or to change the way that they do business to try to achieve an accounting outcome.
And I think that's completely fair. To me, the benefit is the closer alignment with the economics, not that it changed how somebody does or doesn't manage, or it caused them to go back through their contracts and understand things they didn't understand, because we've heard some of that. We never read our contracts before. Well, that wasn't an intended consequence of the standard, but the alignment of economics might be.
Okay, I don't see any other hands up. Any final comments on benefits before we move on? Yeah, well, thank you for all the input on this. I think it was a great discussion. So we're going to shift now. I'm going to turn it over to Richard, and he's going to tee up the cost discussion.
Thank you, Mary. Good morning, everyone. Welcome to topic 2. And in this session, we are going to talk about the costs. So as with any new guidance, there were costs to implement topic 606, or like many participants just mentioned, there's a cost to implement a principle that is hopefully timeless. So the purpose of this session is to summarize what the board expects the cost of revenue to be at issuance as articulated in the basis for conclusion in update 2014-09, provide an overview of what the staff has learned from the outreach conduct to date on the cost of applying the revenue guidance, and get some feedback from the roundtable participants on the expected and actual cost of the revenue guidance. So back when the update 2014-09 was first issued, the board expects certain costs to be incurred by preparers, investors, practitioners, and other stakeholders applying the revenue guidance, such as costs related to change to or development of new systems, processes and controls, increased consultation costs, and audit fees. So to reduce the expected cost, the board made modifications and clarifications, such as providing certain practical expedients, adding illustrative examples, and as Doug and Sandy just mentioned, allowing optional transition method. So in addition, the board later made subsequent amendments to clarify or provide additional guidance in the revenue, certain aspect of the revenue guidance, and defer the effective days. Investors found themselves having to learn about the new guidance, update their models, keep both new and old models running during the transition, and understand the changing revenue trends during the transition period. But most of those costs were non-recurring. On preparers' side, those who reported significant changes due to the new guidance tend to spend more on implementations. These costs often came in the form of hiring additional staff, updating IT systems, implementing new internal controls, and more audit fees. So with that, we could open the floor for discussion on question 5 through 7 on the handout.
Angela?
Yeah, I can kick us off. I know the questions were focused on implementation, but I want to shift that focus a little bit and just really emphasize the ongoing costs of compliance. I think one of the things that we sometimes struggle with our clients is that they say, well, I adopted it, aren't I done? Well, do you have revenue this year? Then no, you have to continue to apply the standard. And it's not something that you can just document once or assess once. You have to continually update that assessment. Maybe your model didn't change, your business didn't change, but you still have to go through that documentation process to make sure that the accounting, it really didn't change, right? Do the accountants know what's going on? Did something change? And then you have situations where the business really did change. You've got a new product line, you've acquired a company, you've got something changing. Well, you've got to go through that implementation process in a sense all over again, right? And so I want to emphasize that there is an ongoing cost. And in particular, I think while I certainly agree with the benefits of a principles-based standard, there are costs associated with the principles-based standard, and in particular, a one-size-fits-all standard that are borne in particular by smaller companies, right? That we sort of sometimes forget about, I guess. In particular, just that requirement with a lot of the judgments that are involved, because the standard, because it's one size fits all and it's principles based, it has to be broad enough to encompass anything. But that means that there may be a lot of guidance that you have to go through to make sure it doesn't apply to get to your answer, right? Even a simple example of a restaurant, they still have to go through and apply the model, and it has to be audited, right? We won't forget that. And then, so that not only does the company have to have all of their documents in a row, then they have to support all of those assessments that the auditor then has to come back and audit as well. So again, we can get into some of the implementation challenges later, but I just think there is a cost associated with a principles-based one-size-fits-all standard that it's important to acknowledge.
And this might be a tough follow-up to answer, but just how do you think of those costs comparing to what you would have had it under 605? Because I think if you had new transactions or new arrangements, you'd have to go through things again. I granted that there's certainly more judgments and variable consideration under 606, but just curious in terms of level of effort if you see it as much different.
It is a very interesting question, Mary. And I hesitate to be overly definitive, but I would hesitate, or I would venture a guess to say that, quite frankly, the costs are more, and in some cases significantly more because of the judgments, in particular around variable consideration. but also some of the judgments around identifying performance obligations and which ones are distinct or not and what that drives. We've had several instances where, clients with significant variable consideration trying to, that was not a license and sales and usage-based variable consideration, so something that had to be estimated, trying to estimate that, implying the implicit price concession guidance to get to that. Again, I understand why it's there, but the costs associated with going through that thought process. The old guidance was, quite frankly, in some cases at least, more simplistic because it had bright lines. You really didn't have to think about it as much, and it was easier to execute. I'm not necessarily advocating going back to that, just acknowledging that there is a cost associated with it.
Sandy?
Yeah, so I think I would generally agree with the write-up. Certainly it was more difficult for smaller companies and private companies, and certainly, I would agree with Angela. There's still going to be ongoing costs for some of the more manual processes and judgments involved. And I would also say that there were a lot of stressors even after the deferrals and finding the right resources, namely on the people front. And then when you throw in the pandemic, right, those stressors got even bigger. I think we'll continue to see stress in the system, especially with smaller companies that don't have the same resources bigger companies have. We see a lot of material weaknesses in internal controls related to the lack of technical resources to handle the accounting. So it continues to be pretty hard to get those resources. I also have some comments when we get to implementation, but I'll just mention now that there will continue to be challenges for new and emerging arrangements, especially when the accounting doesn't fit neatly and you get to results that aren't intuitive. And because the accounting is hard and there's just a lot of judgment required, I agree with Angela, this is going to generate costs to get to the right accounting because we're not dealing with rules, right? We're dealing with judgment. Now, I do think it's great that the SEC staff stands ready to handle requests on a pre-clear basis, and likewise with the FASB on technical inquiries. But we also have to get comfortable with the accounting outside of those processes, and whether it's pre-clearing an issue or consulting with national office, right? There is a cost associated with that. No, I don't have any specific requests related to this, but just wanted to point out that, similar to Angela's observations, we're going to continue to see cost in the system whenever there are new and complex arrangements and whenever there's significant judgment involved. We can handle the judgment. I really do believe that, but sometimes that does come with added costs.
Doug?
Yeah, just wanted to really reiterate the day two cost element of this. That was the key highlight as I was going through. I think most companies, even if you knew there wasn't going to be a huge impact to what was on your financial statements, there was going to be the initial adoption and implementation costs. So I think in any firm training would tell you, like, don't ignore it, don't ignore it. This is going to impact you. You still have to do an impact, but those day two costs, and I would say particularly for private companies where, and we're seeing it with lease accounting too, companies are going through so much to stand it up on day one. And there's so much of this emphasis on day one that by the time you get to day two, it's like, oh, we didn't really establish those processes, or if we did, they were very manual. And we're a larger, I would argue, more sophisticated private company than many of the, other private companies out in the stakeholder universe there. And we struggled I would say just as much with a lot of those manual type processes that are really hard to, sustain without just that sort of manual effort. So I think that's a really important call out. And then to your point, how it differs under 605, or what it would have looked like under 605 versus 606. I do think it comes again back to judgment, the judgmental nature of the standard. I think, and this was maybe mentioned in the materials, but this sort of concept of, well, you've got 606 in this new standard, but there's also just the ever-changing business landscape. And I think Sandy was sort of, referencing that as we're seeing these new emerging transactions, especially in the software space. And I know we'll get to implementation later. It's now you've got to strike this balance of, you've got a really judgmental standard, you have an emerging transaction or accounting issue. And now you've got to wrestle through that. And so, and I know earlier we were talking about benefits of and costs of, you've got these firm guides that are creating maybe non-GAAP gap. And it's like, as a preparer, I like the judgmental nature of the standard, but I also recognize when I need some help, and I know my auditors are going to go back and point to their firm's monograph and say, this is how we've applied this. And so I do think there is that sort of balance from a cost perspective on maintaining the spirit of the judgmental based standard, but also providing preparers enough information to make decisions and get to that, accounting answer that best reflects the economics. And I think that can be really challenging on an ongoing basis. And some of that is related to 606. Some of it is just inherent in the complexities of revenue recognition. And sometimes there's just complexity that is going to be complex for complexity's sake. So, but I do think from a cost perspective, that balance of being able to, have meaningful implementation guidance, for lack of a better word, but maintaining the spirit of the judgmental nature of the standard.
Allison?
So to put a little finer point on the ongoing costs related to the level of judgments that are required in the standard, I would say within our national office, the 3 topics that we see the most often come up to the national office for consultation involve principal versus agent. Not a week goes by, not a single week goes by without an interesting principal versus agent answer. So I'm really hoping to get a chance to talk about that a little later. Principal versus agent, contract modifications, identification of performance obligations. Of those 3 topics, we frequently see 2 of them, principal versus agent and identification of performance obligations, take a further step in terms of pre-clearance with the SEC staff for many of our public company registrants. The reason being is the nature of the judgments are so significant that registrants are looking for more certainty in their accounting conclusions prior to having a filing with the accounting embedded in it. So I think that is just an ongoing cost. That's just a reality. There's no way that an accounting standard, of course, can eliminate the need for some of that, but I think it's just an important part to recognize that the level of judgments are significant, and they do, in my opinion, seem to be concentrated in a few specific areas.
Stacy?
Yeah, I agree mostly with I agree with the write-up. I think we had every single one of the costs that you outline in there. And I think, we expected a lot of those as far as the one-time costs. I kind of put costs in 2 different buckets. One is costs that you feel like, yep, I knew that was me a cost and it feels good. Like, for instance, if we release Halo and we had one little game episode that wasn't delivered yet and you don't get to recognize any revenue during the holiday, that doesn't make sense. It doesn't take any time, by the way, to take all your revenue and defer it. It takes more time to figure out what is that game episode worth. I would say that's good justified cost because that's what it cost me to have accounting that makes more sense. Then I would put it into all the judgment. Again, I think having a principles-based standard has costs. I think most people would say that that's good costs and justifiable costs, but it is true cost of ongoing standard setting or the standard. I put the second bucket of costs of we've spent a lot of costs and the answer doesn't make sense. Those are harder, I think, for us to wrap our brains around. For us, that's term licenses. It is just different. And we'll talk about licenses later. But for instance, the costs that are significant ongoing for us are actually people. So contract reviewers, we actually touch thousands of contracts because of term licenses, because we sell subscriptions. We do sell things differently. If it's a perpetual license forever, we think about that as something that we protect and we don't allow a lot of modifications around. For something that's a term license subscription, we think about it very interchangeably with a SaaS offering. And so we have a lot of modifications around those. And then we need to have humans that touch every one of those contracts and every one of those modifications. The systems to set up as far as to separate out performance obligations, to assign the right values, to go in and adjust those. It's very high cost. It is an area that also doesn't make a lot of intuitive sense. We keep having to re-explain it to investors, to our senior leadership, why we do these. And so that's the bucket of cost I would say feels like it's a much higher cost and it doesn't make intuitive sense for us.
Susan?
I wanted to share an observation around the continued scrutiny for judgments and estimates that are there because of our principles-based standard. And I recall back in May of 2016 of the then SEC chief accountant Wes Bricker, when he was talking about speaking to audiences and saying the SEC staff will respect well-reasoned and practical judgments. When those judgments are grounded in the principles of the standard and the company has considered the utility of the resulting information to investors. And he also would follow that up usually with a statement like, and that takes a lot of time. So make sure you're working on your positions. So I just observe that over the years, perhaps we've moved a little bit away from that. And I say that because I think it trickles through the system. So regulators, PCAOB might be asking more questions around certain positions. And as a result, you have audit firms I've observed that would ask more questions and give more scrutiny and then demand more documentation. And then you have the companies that are reacting to that and having to hire expensive consultants to document their positions and support all of those positions. So I've just wanted to share that observation. I know we can't completely eliminate that cost in the system because we have a principles-based standard, but my hope is that we can somehow get back to some of that balance.
Brent?
I'm sorry, did you call me? I didn't hear.
Yes. Yep.
Okay, yeah, thank
Go
you. Yeah, so I mentioned we didn't have a lot of change, so we didn't have a lot of cost. Obviously, at implementation, we had to go through with the auditors and document everything. I would sort of chalk that up to what others were mentioning. Kind of, it was some good hygiene, so probably was money well spent in some ways. As I sort of reflect back, the biggest cost probably was the lengthy period of uncertainty, because people, the audit committee, what's going to change? Is anything changing? Updates? You have business people, hey, if I enter into this contract and the rules change, what's going to happen? And so we were looking at, we potentially would have revenue that disappears, or we would double recognize revenue, and it went on for a fairly lengthy period. So that was costly from a stress standpoint, I guess, but maybe not a real hard cost. But my takeaway from that is, one, don't make rules unless they're important. Obviously, revenue is a pretty important line of the P&L. But I also believe that we always retroactive restatement should be permitted. If somebody wants to incur the cost to do that, it's the best way to get comparability. And so I feel like that should always be an option.
Thanks. Meredith?
Yes, I'll reiterate a lot of what Allison said, and to respond to your question, Mary, about the ongoing cost relative to prior. I'd say we have revenue continues to be like the number one accounting topic that's consulted on in the national office. They are the same topics, the judgmental topics, the principal agent, nature of the promise, variable constraint. A lot of times it's companies and teams that just want to talk it through because there is a lot of judgment, right? And feel a little more confident in their judgments. I would say there is more cost than accounting for the bright lines of SAB 101, right? But so you're balancing that with all of the benefits that we've acknowledged. But I do think that ongoing cost is not insignificant.
Mark?
Yeah, I wanted to mention, it's related to the earlier discussion about best practices and how this could affect behavior. I see the behavior part as more of a cost within software. From what I've observed, there are companies out there that are actually changing business practices as a result of the accounting. These are a lot of, on-prem companies, term companies. And my suspicion is they're doing that because the accounting does not necessarily reflect the economics of the deals. In advance of 606, I saw companies doing this. More recently, I see them, I think, pretty aggressively changing the structure of their deals and cancellation clauses to kind of present a picture on the P&L that they think is more representative of the business. So I see that as a cost. I don't think that was the intent of the rules. And then the other cost, just to reiterate, that you guys mentioned, is I do think it's a real cost, both for investors and for company representatives, to help investors understand all the moving parts underlying the GAAP numbers every quarter. It's very challenging in software. Some companies do a good job doing that, other companies don't. But it's still a cost today, I think.
Tomo?
Thank you. We do agree with the cost that was outlined. Two other items, both related to day two item. One is there's from our industry prior to 606, a lot of the discounts were recognized on day one. Now it's being allocated to future service periods. So there's more misalignment between revenue recognized and cash flows. So there's a lot of confusions that we are hearing from our analysts and investors, where we do see our analysts trying to reconcile back to a cash-based revenue number. And the other related to feedback from our investor community is confusion around cost deferrals. A lot of them think that this is an adverse impact to the quality of earnings, especially when there's a change in life. So when there's a longer life, typically we think it's a good thing, but investors think that's a negative thing. The other thing from a compliance control perspective, I mentioned earlier the benefit of the standard where we work much more closely with the businesses. So I think our understanding of the business has improved, and the controls to ensure that the financials are accurate and complete has improved. But it is a struggle to provide that tangible evidence to our auditors to say, hey, we are more involved. They feel that we have a better understanding of the business. We can explain more and better. But when it's trying to document that in the auditor's work papers, it is a much more difficult evidence to provide. So we seem to be implementing controls that seems to be there only to for auditor documentation requirements that we don't rely on that much. So I think that's a cost where we're seeing that there's a mismatch between the control that we really rely on versus control that mitigates the audit risk.
Alex?
Thank you. I'll probably highlight a couple of factors also related to the ongoing costs. On one hand, new types of business models continue to evolve. New companies also get set up all the time, and 606 certainly is not simple and is not something that a new company will have going correctly right off the bat. So typically, there needs to be implementation done for them. The new models, it's not really a 606 issue. It's just fact of life, and if 605 was still around, they'd have to be dealt with as well. But different type flavors of SaaS, different pricing models, value-based pricing, hybrids, professional employment organizations, and open source software. All this creates different challenges, and principal versus agent, just about every flavor imaginable, and then some. I actually find that it's very rare these days that I would think about how this would have been accounted for under 605. It's just so far out in the past that I don't know how meaningful that comparison or that thought process would have been. The other thing I think somebody mentioned is the focus on making the developing estimates and making judgments and documentation around this. And I think over time there is higher expectation on the level of documentation from the auditors, PCAOB reviews, etc. So this kind of flows then down into the companies having to document this more and more and put better quality judgments and calculations support into what they do. To some extent, I feel that 606 is a bit, because it's a principle-based standard, it's a bit of a living and breathing organism, so to say, because, a lot of people in this room have been around through the early days, and we've probably read all these books and TRG papers and everything inside out and multiple times. But the new generation of people is coming in, and they're learning, but they don't necessarily have the same history. And so I kind of feel sometimes there may be changes in judgment that happen, or changes like looking at performance obligations. Why is this not a performance obligation? Well, that's kind of how we've transitioned from 605, and we sort of we knew that this wasn't a deliverable under 605, so like generally it should be more or less the same. Well, for the new people it may not really matter much, all this history. So there is a risk of changes in judgments, sometimes within the existing contract, sometimes for similar contracts as they come up. There's also, because it's a principle-based standard, and I think between the big four books, probably about 3,000 pages of content written. So it's actually also relatively easy to miss something there. So if you like maybe dealing with a particular type of transaction, sometimes things may be easy to find, sometimes it may be difficult to find, and then you realize later on, well, that guidance was there and you're not really following it. Is this now an issue? Is this an error that you made? So that's some of the observations. I guess one other thing I'll mention is kind of the normal cycle of how any kind of knowledge develops from, gray hair to being commoditized. And I think some of people tend to go simpler with judgments as a result of this. Again, to the point of living and breathing organism, like let's say material rights, where we used to think, well, if something in the future is priced at a different level, is this a material right? What are the arguments for and against? Now I find it tends to be a lot simpler. Price is lower than on the first item, material right, done, move on. So I guess that's the observations.
Pat?
Yeah, I was just thinking that, this discussion, you need to frame in sort of different buckets of cost, right? Clearly, any change has cost, any accounting has cost. We live in a world where, we have the PCAOB supervision of auditors, we have the 404 expectation for internal control. So all of those are costs that are there, no matter what your accounting model is. And I think somebody said it, revenue is a pretty important performance metric. So you'd say, well, having a standard, you're going to have some standard, right? So there will be some cost to comply. So it's really focusing, I think, on those sort of things that you can influence, or maybe where there's unnecessary cost created. We had some examples of some of the areas where there's still challenges, maybe areas where people don't think the model's working. And I think, maybe focusing there rather than just on the, macro, yes, lots of cost to implement, lots of cost on an ongoing basis, but, revenue is a pervasive event for companies. So you have to do some accounting under all those circumstances, no matter what. I think the other point, and maybe something you mentioned, Alex, that all of us who maybe were around at the time of implementation, there was a desire at the time to perhaps make implementation potentially simpler than it might have been, which led to maybe some expedients, which probably in the moment were helpful, maybe still are helpful, but down the road for all the people who are coming in trying to learn the model, trying to understand why are those there, why aren't they, why don't they exist in other places, that does create some friction and some cost later on. So I think thinking about those a little bit in retrospect as to, they made sense at the time, but in terms of that resiliency and longevity of the model, do they still make sense?
Chris?
I guess the only thing I'd want to add to some of that is, I think getting rid of industry guidance probably is somewhat of a detriment, especially in the financial services. And I think just thinking about the day one costs, we didn't expect a lot of changes, so there's still going to be a lot of costs that were going to be incurred in day one. But I think I'd reflect what a lot of people said, is that even though we incurred those costs, there's actually a hidden benefit to it, and we all got to understand a lot of things. The day two, we probably expected the cost to not be significant ongoing, but that's kind of flipped. And where that's flipped the most is that, for the financial services industry, there's a very large focus on expense. And so going back to where someone talked about principal agent, you know, in financial services, there's a fine line between when you're doing something on behalf of a client versus where you're acting as an agent as a client. And so that is resulted in a large amount of costs in doing those analyses, whereas previously some of that would have been covered under industry guidance. And so creating that principles-based for our industry has actually created a large cost and also a real demand to try to structure things more so that you're an agent, which then also has hidden cost to it. So I guess overall, just that there are incurring ongoing costs because of the inability to really kind of create some industry-specific guidance for RevRec.
Mike?
Yeah, I was just going to share our experience. So, you know, whether it was costly or not really just depended on where you sat in the company. So, you know, half of our business, you know, has a large government customer. Those contracts tend to have very similar terms, and you know, we really didn't change our accounting in that area, so not costly at all. But in commercial aerospace, the contracts tend to be very long-term, very complex. So we spent a lot of upfront money on consultants and, you know, in enhanced staff costs. But if I think about it on an ongoing basis, I can't really say that there's a lot of incremental costs because all of those complexities were there before, and we tended to have to review in depth and document our positions on just about everything we enter into. And that's no different today than it was in the past.
David?
Yeah, I would say we've run into a few costs. I think one of the ones that we didn't really expect was the capitalized selling costs. Amortization is a very important word for us, and we don't consider that to be amortization. We consider that to be something that is amortized. And so it's very difficult to sort through the financials to understand what are operating assets that are amortized and what are, you know, intangible assets acquired through investing activities that are amortized, especially on private companies and especially in interim periods. We often just get the add back on the cash flow statement and have to make a lot of judgments. As mentioned before, the delta between the income statement and the cash flow statement in some industries is a problem. And it's not necessarily, I'm not in the camp that thinks we want the income statement to look like the cash flow statement. We have two statements for a reason. But the reconciliation between the two or understanding the relationship there, and it might be the cash flow statement or even just the balance sheet, understanding what deferred revenue relates to what sort of industry types, because we have a lot of companies that have a mix of contracts and transitions, and we kind of have to rely on them that this drop in revenue is because they're transitioning, but we can't correlate that to the balance sheet or the cash flow statement to really get a bunch of assurance on it. And then the usual suspect of gross versus net. And from our perspective, it's not, we don't have a strong opinion that this is revenue or this is not revenue, but it starts to affect it, not starts to, but when you recognize gross, and it basically makes margins not sensitive. And so you have a large amount of revenue in there. And so looked at from that perspective, maybe could have different answers because we use margins and we have to move. This is the only thing that we do really move and adjust out of revenue is when we use margins.
Melissa?
Yeah, coming from an auditor from a small, you know, firm that audits smaller companies, private companies, I just wonder, I guess I saw one of the maybe unintended consequences being companies moving away from issuing GAAP financial statements. So just seeing the revenue recognition standard and the lease standard being so overwhelming that they're saying, you know, we're not going to do this. We don't have the resources. We're going to go to cash basis, tax basis, something like that. So maybe I see that as an unintended cost of issuing the standard because they just didn't have the resources. And then the ones that did have the resources were still doing a lot of hand holding. So anytime they have a new kind of contract, new revenue stream, an acquisition, like Angela was saying before, we're in there walking them through, helping them apply that 5-step model because they just don't have the people and the resources to do it themselves. So I think that's still going to be an ongoing issue for them.
Thank you. One of the expected costs that we had that I don't think we've heard too much about so far this morning is about IT costs, system readiness. Just curious if there's any input on that perspective. I know that was one of the reasons we had to defer the standard was the lack of system readiness. And just curious if there's any input on that. Tomo?
Thank you. We did incur significant IT cost, both on the revenue side and also trying to capture all the costs that needs to be capitalized. We are spending a lot of time through more manual efforts because what we are finding out is that the system that we implemented it doesn't allow us to account for transactions in a complete manner. So I think it is one of those ongoing costs that we are somewhat struggling with.
Stacy?
Yeah, so I was, we incurred probably our most significant costs were IT costs. Again, our models were pretty simple before. You deferred everything and you did it in Excel, or it was ratable. And so picking apart pieces and trying to allocate, we invested significantly in our systems. In addition to similar is we've hired a lot more people. We probably 5x number of people to actually touch contracts that the system doesn't have the ability to do, or even on the large portfolios. I would say though, some of that system cost, I would say was not just for the new standard, but as we get more complex business models, we have to do that anyway. So, I wouldn't put it all towards 606 costs.
Angela?
Yeah, I guess maybe two thoughts. One, we have a lot of private company clients that, to Melissa's point, need handholding, and that goes to the IT as well. A lot of times they looked at the costs associated with implementing a system and said, I don't have the resources, nor can I justify taking IT dollars away from the business to implement something that doesn't benefit the business, quite frankly. And so we still have a lot of clients that are doing it manually, right? And there's an incremental cost associated with that manual work that maybe they didn't take into consideration and should have, but nonetheless, the cost of an IT implementation were so large. Having said that, the flip side of that is, to Stacy's point, a lot of times those IT systems can't really handle the judgments. And even if you did implement, there's still a lot of manual effort on the back end to try to make sure it matches what should come out based on the standard.
Alex?
I would say, yeah, a lot of companies incurred substantial automation costs. To some extent, though, I think it's a little bit coincidental because, as technologies continue developing and cloud becomes much more accessible, and cloud technology specifically, the same goes for the accounting for things in the cloud. And so this made, as the cloud technologies were maturing through the mid 2010s, this made implementation a lot easier for companies to go through. So I think a lot of times it kind of coincided with the maturation of those technologies. Right now, we see kind of the next thing is coming up is artificial intelligence. And again, companies are catching up on this to use this, for example, to evaluate contracts, including revenue contracts. And so as these things become available, of course, companies take advantage of this as well.
So we've talked a lot about the nature of the costs that were incurred. And I think what we've heard is a lot is consistent with what we've identified. I think we've also heard some other things. I'm just curious if there's feedback on the magnitude. So I think what we've heard in our outreach is, in addition to the types of expected costs, they were much greater than what companies expected. And just a personal observation, which you can agree or disagree with, is I think a lot of that was there seemed to be a lot of paralysis in the system, at least in the first year of, maybe it goes back to what Susan said on like people having to think about judgments and nobody wanting to be a first mover, and maybe companies being a little hesitant to take a position before they saw a firm guide published or a task force paper published. So just curious on any thoughts on the magnitude, if some of those systematic challenges are unique to revenue. I'm guessing they probably occurred on leases and CECL too, but just curious on that from a system perspective, not IT system, but just like a accounting system perspective and the magnitude, and just any observations that we should consider going forward. I guess that was a tough one. So I don't know if the silence means people agree or disagree, but we'll continue to explore that through PIR. Oh, sorry, Stacy.
I'm not sure if you meant like magnitude as far as dollar amounts, Mary, or
I would say level of effort and level of consternation, maybe about making judgments and being able to move forward with your implementation.
I think what was key for us is that we actually, one of the things I think we did well was people pushed me outside of my comfort zone, which was just make a call right now, what you think is probably going to happen. Otherwise, you can't get your systems in place. So we started really early with putting those into the system. We also spent time, I spent time in Germany with SAP as they were coding their systems. And so I think we spent more time with software providers to make sure we could actually build judgment into the system that I think was helpful. We also do use the same machine learning and AI to go through and review contracts. So I actually think some of this, because we have so many people reviewing contracts, it actually does push you to use more technology, which I think is actually a good thing. This, not just because we're Microsoft, but just in general. There's certain things you cannot replace a human with, but there are certain things like, right, if you review a contract and realize you didn't actually have to adjust for it, how can you use technology not to touch that? So I do think that technology will relieve some of this extra cost in the system.
Monique?
From a slightly different angle, when we were working with some of the smaller clients, particularly in life sciences and tech, both on a consulting and an auditing side, what we found is as we got into it, there was a lot of complexity in the contracts, very consistent with there being sort of smaller players in the marketplace. And the cost ballooned for them because sometimes they were relying on having conversations with the auditors, and we were saying, we've got independence to worry about. And then they were having to bring in, other consultants to assist them. They were hard to get. They were very pricey. Systems did not match the needs. So they couldn't solve all their problems with getting new systems. They needed consultants and systems and people. And I think for that category of customer, it ballooned. I think for our bigger customers, it was probably larger than expected, but it wasn't multiples. I think for that smaller private, not tiny, but not big yet, with high complexity in their revenue, it was multiples of what they were expecting.
Steve?
Maybe an observation. Many folks in our shared services really didn't understand the change of when we adopted 606. And when folks, when you get an invoice, this just clearly put the account receivable for the full amount and recognize revenue, and to explain that you might have something less under the new standard if you believe you're going to get 90% of the revenue. So that notion of that two-step process that we all learned in intermediate accounting has changed, because now you're starting off what you believe your right of cash is day one. So this notion of booking a full amount and then putting an allowance against that receivable going forward based on history or based on what you could expect into the future was conceptually difficult to explain to folks who really work on these processing changing and had to explain that. So that took a lot of education, a lot of time, and also try to get that into a SAP, right? Because if you have customers that are only going to pay 90%, then that's your starting point, and trying to find out who are those customers, because that's where your receivable starts. And then you build your allowance after that point. So again, I guess, again, I heard this earlier, I think judgment costs more. But also judgment also gets you to a better place, closer to the economics. And I'm willing to do that. It makes more sense. And I think, so again, the cost benefit, I'd rather deal with the economics being closer to the accounting.
Tomo?
I mentioned the costs incurred in implementing the revenue standard. But one thing that I do want to mention or highlight is that the challenge we had was implementing the revenue standard and preparing for the lease standard at the same time. So that, I think, if you add those two, it was a significant effort on for the company.
I think we're all caught up on the queue. Before we wrap up the cost section, any final thoughts or comments? Susan?
I just wanted to clarify for the record, our revenue book is only 300 pages. So for those looking to cut costs.
Thanks for that. All right, so we're a little ahead of schedule. What we're going to do is we're going to start topic 3. Topic 3 was originally going to be after lunch, so we're going to get that started. Jennifer is going to kick us off, and we are Not going to waste any time. We're going to start with, I think, what everybody's favorite topic is, which was mentioned a couple of times, is principal, agent, and consideration payable. So she'll kick off an overall tee up, and then we'll get up into those, and we'll go till about noon on that.
Okay, thanks, Mary. I'm so excited to kick off everyone's favorite topic. So for topic 3, we'd like to solicit your feedback on those areas within topic 606 that were reported to cause implementation challenges. We are going to split the discussion, as Mary mentioned, into 3 sessions to allow for enough time to talk about each group of topics. So we're actually going to start with what is designated as topics F and G in the handout. And then we'll talk about areas A through E together, and we'll talk about the last 3 together. So revenue recognition has historically been an area of financial reporting that is complex, and it often requires significant judgment, as we've been discussing today. In addition, it's an area that's highly scrutinized. All stakeholder groups give a lot of importance to an entity's top line results. The new revenue standard was expected to have many benefits, including providing a more consistent and coherent framework for applying the guidance, which we discussed as part of topic 1. However, as Allison mentioned, it was not expected to eliminate all of the challenges or judgments, and these may be required on an ongoing basis and accounting specifically for certain transactions. Based on our PIR activities, the staff identified 10 areas within the guidance that were described by stakeholders as challenging to implement. At the direction of the board, the staff performed in-depth research on most of these areas and further discussed the results of that research with the board. The focus of the staff's research was to identify the root causes of the issues and consider if there were feasible improvements that the board could consider to provide relief in these areas. Broadly, the staff identified that any potential standard setting to address these issues, other than possibly the addition of examples, could result in changes to core aspects of the model and potentially divergence from international standards. The feedback that we will obtain from you today will help us better understand these implementation challenges and to evaluate whether additional action by the board is needed, and if so, any suggested solutions that you might have. So with that, I'll kick off starting with principal versus agent. Actually, so to group 2 together. So 2 of the areas that stakeholders have told us that are complex and challenging to apply and require significant judgment are, of course, principal versus agent, and also consideration payable to a customer. Although these areas were addressed by the prior guidance for revenue, their application changed in some respects related to the control principle introduced by topic 606. Auditors and regulators observe that principal versus agent remains a frequent area of consultation, as we've talked about today. Investors note it can be difficult to understand the judgments applied by seemingly similar entities, for instance, industry competitors, especially when those entities appear to be arriving at different conclusions. Principal versus agent was the subject of the first 2 TRG memos, and the board subsequently issued Update 2016-08 to clarify the guidance by better linking the control principle and the indicators. On consideration payable to a customer, stakeholders share that it can be difficult to determine whether this guidance should be applied to payments made to a customer's customer or whether such payments should be accounted for as a marketing expense, particularly when no contractual linkage exists between the entity and the customer for payment to the customer's customer. Stakeholders noted that the accounting determination can be pretty challenging. The staff has observed that generally in practice, there's been a trend toward including implied promises to a customer's customer as a reduction of revenue. Similarly to principal versus agent, multiple questions about consideration payable to a customer were covered in 4 separate TRG memos. For example, TRG discussed whether or which payments should be subject to the guidance. They did not come to a definitive conclusion, but the TRG did discuss specific situations in which it would be appropriate to record payments to a customer's customer against revenue. Another related issue that some stakeholders have brought up is presentation of negative revenue. Although the TRG also briefly discussed this issue, it did not reach a conclusion. The staff has noted that in practice, many stakeholders are applying the previous guidance under topic 605 on customer payments and incentives by analogy, and there seems to be some level of comfort there. So in general, the FASB staff has noted increased complexities associated with certain emerging business models and transaction types, particularly related to new technologies and increased multi-party arrangements. A common thread that underlies many of the questions in both of these areas is the identification of the customer. Just a few common examples. I don't think any of these will be a surprise to anyone, but that where we typically see these issues are online platform providers, managed healthcare, and payment processing. The staff has noted that due to the often complex nature of the arrangements themselves, applying the guidance on both principal versus agent and consideration payable to a customer may continue to require significant judgment. So with that background on those two topics, we'd like to turn to question 8 in the handout. Particularly, do you have any feedback on these topical areas? And if so, what solutions would you suggest for the board, and what level of prioritization?
Allison?
This is my chance. I'm excited. All right. So as I think about the judgments involved in both of these topics, and I'll do principal versus agent first, and then talk about consideration payable, if that's all right. The world of gross versus net and principal versus agent has been a hard topic for a really long time. I remember many debates with many folks at this table and predecessors of folks sitting around this table on old GAAP and how to apply the model under 605 and then the indicators that had come up through the EITF consensus. The thought that, okay, maybe 606 will solve the problem, we'll have a control principle. Then the standard was issued, then TRG discussions. The guidance has come a long way, and it does work well in many situations. But I think what we're experiencing is if you're trying to think about an accounting standard that needs to maintain its relevancy and maintain its ability to help support reasoned judgments, applying the principles today to evolving business models has become challenging. And I think that there is an opportunity for the board to consider further enhancements in this area. My thought would be, and I can talk about it in a little bit more detail in a minute, but around additional examples that could help illustrate a few key points where I think people are struggling with applying the model today. The reason why, from the fact patterns that I have seen, that there is a struggle with evolving business models is because those principal versus agent determinations involve not just one additional party in addition to the company for whom we're doing the accounting, they involve multiple parties. And amongst those multiple parties, there are not contractual relationships amongst all of the parties or even with the entity for whom we're doing the accounting analysis. And under a control principle for principal versus agent, you really do need to look at the contracts. I mean, that really is inherent for any type of revenue contract under 606. You start with the contract. And so there are companies that are entering into multi-party arrangements where they are taking on economic risk related to those arrangements. And they believe that that economic risk and the reward associated with it should be reflected in the revenue line item, gross revenue, and that the risks should be reflected as costs. But the absence of having contractual relationships amongst all the parties makes applying the accounting model very challenging. And you might think to yourself, well, why is it that a party would take on economic risk without having contracts amongst all parties? That's a question that we've debated and asked our clients. And what we hear is that in certain situations, payment processors, managed care, the design of what it is that the company itself is doing is designed to provide some sort of a solution that would inherently reduce the cost or risk associated with activities performed by other parties in providing the ultimate item for the customer, even in the absence of contractual relationships. So as I've thought a little bit more about this, looking back at the examples, like why is it that people are struggling? If you go back into the examples, we have 6 examples in the standard. They're all very helpful, but in every single one of those instances, there's only one additional party involved in the principal versus agent analysis. There isn't an example that has multiple parties involved. And then if you further look at those examples, there's an emphasis on the nature of having a contract between the company and the other party that's involved in providing the good or service to the end customer. There isn't a scenario involved where you see multiple parties and absence of contractual relationships, and to what degree economic risk and reward even matters in a control principle. So I think there is an opportunity to perhaps add an example or an illustration to the standard to address some of these complexities and how they might, how the control principle could potentially be utilized to reach reasonable conclusions. I think that principal versus agent is an area where we have line by line, word by word convergence with IFRS 15. And I personally value that quite a bit and wouldn't want to see any changes to principles or existing examples that would take that convergence away, but perhaps adding an additional incremental example, even if the ISB chooses not to take that up, at least it's incremental guidance that exists in US GAAP that practitioners around the world who use the principles of the control principles could use, even if it's not specifically embedded within IFRS. The point around determining a difference between what is a service and a right to a service is a nuanced point that was added with one of the ASUs that came out as part of the TRG process. And I believe that that concept is not well understood in practice. Again, looking at the examples, we have two instances when right to service is really the focus area of the specified good or service. It's the voucher example and the airline ticket broker, neither of which are really great real life examples, if I'm being perfectly honest with you. I also find that companies in trying to apply the 5-step model will always start with looking at whatever contractual relationships they have present and figure out, okay, who is my customer? And then they take that and advance that through the model. And when we get to principal versus agent, that doesn't always work. Because if you are an agent, your customer may be an additional party in addition to the party to whom you might be providing a primary activity. So I think that gets people turned around. And I also think that related to specified good or service, that is sometimes a circular analysis that you have to analyze contractual relationships, figure out what you have control over before back solving for what is the specified good or service in the arrangement, when technically the way the model is laid out, you should first identify the specified good or service. We see people head in the wrong direction because they've misidentified the specified good or service. I said a lot. That was principal versus agent. I can take a turn and do consideration payable now. That's all right. Okay. So consideration payable. I think that Jennifer summarized it pretty well, that the TRG discussions from my recollection, and Mark can validate this for me, former TRG members, I feel like we came away from those conversations, it was a little bit unsettled around consideration payable. So our experience today on these issues, consistent with what Jennifer had summarized, is that we have increasing levels of conversation with our clients around whether there is a valid expectation that the company will provide an incentive on behalf of the party with whom they've contracted. Maybe it's a supplier, if you're thinking about a platform company where you're the middleman and then you have a supplier and then you have an end consumer. And those questions or that analysis, it's a very difficult judgment to make. And in order to be able to help our clients understand the principle behind that, we find ourselves kind of making it up to explain what it means to have a valid expectation. We've incorporated a lot of that guidance into our book that I know that some folks, Eric is not so thrilled about having these big books. We've incorporated into our books, trying to be helpful. It was also helpful that the concept was solidified by NSCC staff speech. So that's, again, an area where, in our opinion, to get to the answers that seem to be accepted in practice, you're using speech gap in a way to get to those answers around valid expectation. And then maybe if I could make a comment on negative revenue, to answer those questions, we look to old gap. So this is an area where having a lack of further information in the 606 itself means that we use speech gap on the one hand and then old gap on the other. We capture all of that within the books because that's where we have to put it, since it doesn't actually exist in 606. So that could be an opportunity to the extent the board decided that additional implementation guidance in this area could be helpful. And I totally have taken way too much time, so I'll stop now. Thank you.
That's okay. Meredith?
Okay, so principal agent, I agree with Allison. Like, I'm not an advocate to change any of the words unless the ISB was going to go along with it. I think maybe some illustrative examples of some of the emerging business models that we see that have challenges could be helpful. I think some of those arrangements where there's the economic risk that's being taken on, there's some interaction with, the 460 scoping guidance and how you consider whether or not you're guaranteeing your own performance. So that kind of plays into some of that judgmental complexity. I think the guidance is better than the old guidance. The indicators in old guidance, it's kind of a checklist. I think companies still may kind of take the checklist approach first. But that underlying control principle really does, I think, help ground the analysis. And yes, it's always going to be hard. I think there could be some improvements with disclosures with respect to principal agent. I won't necessarily speak for investors, but I imagine it's challenging with some of these different business models, particularly when a company may have a mixed model. And it could be a mixed model where you're principal and agent because you have really different business and revenue streams, but it could be because in different jurisdictions, there are different laws that like may shift the analysis and that judgment one way or the other. And it's really hard to tell then what that kind of mix in your revenue and in your margins. So that's principal agent. Consideration payable to a customer. This is one area where, and we would, I think we've in our letter to the ISB have said the same thing, that this is an area where there might be a chance to reduce some diversity with, a targeted kind of addressing the customer's customer, kind of the platform company question that comes up, and how you evaluate whether or not there's you're providing an implied price concession. And we've seen globally that not all regulators necessarily look at it that way. And so there's a little bit of angst in the system kind of globally on that topic, as well as just comparing company to company. It's very difficult to see or to compare how companies are accounting for those sales incentives. And then on negative revenue, I think some companies are comfortable looking to negative revenue, the old guidance. I don't know that that's the best solution. And I think some would say, well, 606 and IFRS 15 does not tell you, it tells you that it's a reduction of revenue, unless it's for a distinct good or service. And so some would say that the old guidance is not appropriate. So you have mixed practice out there on that line, as well as you have companies who will come up with different ways to reclass negative revenue. And they can be really complex and hard to understand than in the financials, like why is some revenue being reclassed and some not? And in some cases, it's to preserve a top line, but you end up with this answer in your financials that don't necessarily reflect really anything other than just, how they've decided to slice the negative revenue kind of reclass analysis. So I would say those two areas I think are fair for consideration. I think they show up in our IFRS 15 clients as well. So certainly would advocate kind of thinking about that as a potential standard setting activity, but preferably jointly.
Angela?
Yeah, a couple of observations. Maybe I'll start with the easiest one. The principal agent guidance is written from the viewpoint of the entity in the middle. So if you think about a three-party arrangement, company A sells something to company B, that company B then turns around and sells to the end customer C. The reality is we have a lot of clients that actually sit in the company A seat, and they get really confused how to apply this guidance. It's really not a principal agent question. They are the principal, period. The question is, who is their customer? But it still has a gross net impact on their income statement. So I think just an additional example, something to show companies when they aren't the entity in the middle, how to apply this guidance would be really helpful. So that's the easy one, right? I would just observe maybe that when we went from the old guidance that was a checklist mentality, and there were, if I remember correctly, maybe 8 indicators on one side and 3 or 4 on the other, we went to this principle-based approach. I think right or wrong, companies still have that checklist mentality. I think Meredith just mentioned that. They don't always understand this concept that the starting point is control, right? And that what's left are some indicators to help you determine whether or not you control, but they're just indicators. I think that's challenging. I think that, and I also think going from a larger number of indicators, even if you shift the control focus to a list that, quite frankly, in many cases only includes 2, because let's be honest, inventory risk is not relevant for, by and large, for services. And to Allison's point, there are only 2 examples related to services, neither of which are really, quite frankly, fact patterns that we see a lot in practice. It's really challenging to know how to apply that control guidance and those two indicators. One indicator from the old guidance in particular that we see clients really trying really hard to hang on to, maybe is a good way to put it, is do you have the latitude to determine the provider, right? They look at that from a control perspective and say, well, I know that was a risk and rewards indicator, but if I am the one who gets to decide who's going to fulfill the service, isn't that a strong indicator of control? And it's, quite frankly, I think that's a relevant assertion, but it just doesn't sit anywhere. It doesn't exist. And when you think through those three indicators are indicators, and the standard clearly says that they are not the only indicators. But again, none of the examples bring in other facts and circumstances to consider. And so people tend to look at it and go, well, can I even consider some of these other things? Maybe some of those indicators are still relevant from a control perspective view as opposed to risk and rewards. But we struggle a lot with clients trying to understand how to apply that judgment given the lack of clarity. Briefly on consideration paid to a customer, I'll just observe that probably the most challenges that we have with that are in the newer economy type situations, and in particular where we struggle with our clients a lot and where we see a lot of diversity in practice and in some of the firm guidances that we've mentioned, is around when that service being provided by your customer is a marketing service and how you differentiate that from the sale of products or services to begin with. That excuse me, that is a huge struggle. And we had a client issue come up recently where we spent some quality time digging through the other firms' guides and found a lot of diversity even in the written. And then when we looked at across companies, public companies filings, there was a lot of diversity there as well. And so that's just really challenging.
Sandy?
Yeah, so I think, I would say by and large, I would agree with all the comments previously made. So I'll try not to be repetitive because, we've taken very similar journeys and a lot of the consultations that we get in national office with respect to, some of these new and emerging models, industries related to payment processing, ad tech, value-based healthcare. I think a lot of challenges relative to how you apply the guidance and, looking at some of the limited examples that do exist relate to instances where contracts may not be 100% clear. Sometimes, we end up looking at implied promises that are being made on websites and marketing materials. Sometimes, we are told that certain contractual provisions are not substantive. And so you have that added challenge of trying to figure out which terms are substantive versus not. We see a lot of implied terms being brought up that are not in contracts. We see implied relationships. I think, others mentioned that oftentimes it's not just three parties or more parties involved. And then, I know there are a lot of comments related to how you do this for things like services. So I won't reiterate that, but I would say that the challenges also do come up when you're dealing with things that are not tangible, intangibles. There is a lot of technology that's involved in so many of these arrangements, things that happen instantaneously. And so I do know that oftentimes it's very hard for companies to figure out whether or not they truly control relative to the control principle. And so I would say, yes, this is just extremely challenging, particularly when you're dealing with things like services, where technology is involved, where contracts are not clear. In terms of consideration payable to a customer, yes, we see a lot of challenges related to scoping. We see a lot of challenges even trying to identify who the customer is, right? In some instances, there's more than one customer. We see a lot of challenges, as pointed out, with respect to payments are being made to a customer's customer, but that customer's customer is not a customer. How do you appropriately identify implied concessions for those types of payments? And how do you evaluate what information customers have with respect to that incentive payments and whether or not that creates implied concessions? We do get a lot of questions. I'm not sure if this was mentioned, but payments that are being made to a third party on behalf of a customer, meaning sometimes payments are being made to third parties for those third parties to give other goods or services. that benefit the customer. You know, financing is a very common example, but we do see instances of other payments being made on behalf of the customer that's not necessarily intuitive in terms of it being an incentive payment, but those are oftentimes scoped in. So I would say, you know, at the end of the day, I can't really identify areas where I would say the standard needs to be changed. And certainly I did make comments before that I would not advocate for significant changes to the standard at this point. But, you know, as we continue to see issues in this space with respect to emerging issues, new and complex arrangements that come into play, that could become prevalent and that could result in diversity of practice if it's not addressed. I do think that sometimes getting some clarifying guidance on some of those narrow issues could be helpful, as long as it's not disruptive to practice. And in that regard, I know we're going to talk about standard setting later, but I do think that for many of these types of issues where it would be helpful to get some level of clarity, the EITF, you know, they might be well suited to address those issues on a timely basis, because many of those members, right, are very close to those practice issues that exist.
Eric?
Thank you. I'll reiterate a little bit of what Sandy said. I want to emphasize on principal agent. I haven't encountered it being very challenging in the services industry, but it's very complicated when you were talking about digital type assets. The indicators do not work well at all. There's really only two indicators. And even one of the indicators, that is fulfillment, can be quite challenging to wrap your mind around, particularly if you're talking about some type of digital software and it may or may not be hosted on one company's servers. It may be hosted in two places. Maybe there's, you know, a joint effort to host, depending on how the user access works. And so just really reemphasize it, the guidance does just not work for digital assets. I don't think there's enough indicators there. Unlike the others that have responded, I would not advocate for more examples. This group knows well the problems with examples. I think that more thought needs to be given around, well, what are the indicators that would make sense here? Can we come up with indicators? And I think, unlike some other respondents, I would not be opposed to standard setting here, even if it deviated from what the IASB came up with. I think that the IASB standard, if it stayed static, is very principles based. And I would look at anything done here as probably going to be a narrower interpretation of those principles. So it would be hard internationally to have someone tell me I was wrong. I look at it as if I'm compliant with 606, more often than not, I'm compliant with the international standard. On cash consideration paid to a customer, I haven't experienced a ton of challenges in that area. And it goes back to something a few other respondents said, and that is step back and look at the economics. I think when you step back and say what's going on in the transaction, you can pretty easily come to whether there's a reduction of revenue or something else going on. I think you can be informed by the guidance with respect to how do you identify performance obligations to help you with that. And then with respect to the negative revenue point, perhaps it's unfortunate that we took away guidance and didn't provide any guidance. I would not recommend doing anything with that issue for a couple of reasons. One, I think the old guidance just creates compliance problems because you have to track. Secondly, I would think that in light of the fact, a well-known issue that there is no guidance now and there previously was, I think a company could elect a reasonable accounting policy. And to the extent that this stuff is material, one would think that there would be disclosure of how they're treating it. And certainly I would expect that any company would be consistent in their application of that policy. So I would not be supportive of doing any work there. Thanks.
Thanks. So we're gonna do Chris, and then we'll do Monique, Steve, and Stacy, and then I think we're gonna take a break after that. So go ahead, Chris.
All right, thanks. Yeah, I guess for me, I think the one problem that we've seen with the principal agent guidance is it's actually created an inconsistent reporting externally versus what our management actually considers revenue. And I think the good example of that is in the guidance where they clarified what you would do with syndication costs. So for an industry where the majority of what we do is bringing one party access to another party or another market, it's very difficult under the current guidance that you get to where you're an agent in those type of transactions. But many of those transactions, again, the syndicated example in the standard, it's a spot on one, is where there is an obligation of one party to reimburse you for certain costs that are incurred. And when you go to senior management, you say, oh, by the way, now all of those costs, which when you do this on a large scale become significant, are now revenue. They don't understand that. They don't believe it's revenue. They just, believe that it's really quote unquote pass through of something, and they don't like representing it as revenue. The other part then is it creates additional costs because you're going to start having downstream reports that you're going to have to adjust to make sure that, that people aren't being given revenue from a sales perspective that you don't want to consider as revenue. And so I think for us, we believe this is an area that does, especially in the financial services, there is a desire for more guidance so that the economics of what we're doing actually does reflect our external reporting. I think that even further, when you flip to the consideration payable to a customer, there's very often your customers are not just a customer for one product or one service. There's a full relationship that you will have with your customers, and they will provide you revenue in a variety of different sources. But when you think about rebates and rewards back to that customer, you think about it on a full basis. And now when you start to say, well, what does that mean? Where do I allocate it? How do I allocate it? At some point in time, it loses that substance and can often become now an expense, i.e. maybe all of a sudden you feel now it's better as a marketing expense because if I get payable to a customer, now I have negative revenue, which, personally I feel like that's an oxymoron, but those are the complications that the financial services continually run in with principal agent. And I think the external reporting is definitely inconsistent with what management thinks and inconsistent with the economics. And I think that's why we think for both of those areas, there could be a little bit rethink of the criteria of when you quote unquote net something.
Monique?
Thanks. I wanted to focus on the principal versus agent. I spend a lot of my time at the moment working in digital assets, blockchain, metaverse, things like that. And I do sit on the ASPA working group too. So we're looking at this from a guidance perspective as well as our clients. And it is very challenging in this area. And I think the points that have been made about the fact that some of the indicators that are included and the examples are really just not, there isn't enough discussion and information about how to apply it in some of these newer situations. So I think anything that we can do, whether it's implementation guidance, I'm probably less inclined towards something that actually changes the standard, but I understand that may be a discussion that needs to be had, but I think it's going to be very important because even when we reflect back and think about costs of coming in and applying the standard to new industries and new products, new offerings, This is an area we're spending a lot of time on. And I'm concerned we may end up with some real divergence in practice.
Steve?
So I'm going to keep it short, Mary, because I know lunch is coming. So look, I guess, a couple of thoughts. Alice, I think you did really well in explaining what was principal versus agent. But I think what is developed based on the guidance is that there's a weighting on these indicators. And I don't know if that comes clear. And I find that in practice, when I get a lot of challenges, I'm trying to say which indicator is more. And it's not like check the list. And people go, let's check all the indicators. You have many of this and you're in principle. And I don't believe that's how it works. And I think that judgment call isn't clear. And so so something to think about the weighting of that, something that came up. And then the other on, I guess consideration to a customer, what I would say is the world is getting very small. So it's not just marketing. Customers are doing trucking. They're doing other services now. And the question is, I think folks are not realizing that how do you create separability? And I don't know if that notion is in the guidance. It's implied. I heard the word implied. And the thought that I struggle with is, well, why did you hire that trucking industry or that trucking, provider? And he's also your customer versus going to DHL or to another trucking. Well, because he also picks up my products, so interesting. So yeah, I can actually come up fair value. Yes, it's a distinct service, but is it separable? Why did that relationship get created? And it all happened because of the initial sale. So this is where I try to explain that and that notion of, well, is that a net transaction or is that gross? And of course, the business pushed back on that because they want trucking down and operating. But when you start thinking about those kind of things, that it's implied, like why that relationship existed. And again, if I'm a regulator, they might say, I find that very interesting. Why choose DHL versus this trucking? So again, it's just something to think about. And I'm not sure how, and that's going to evolve even more as more customers are doing services for customers. So it's very interesting.
Stacy?
Yeah, I think this was always an interesting one for me because I always looked at the original guidance as anti-abuse, and it was very form over substance, and then being put into a principles-based standard and having it say, we think you're going to get to the same answers, felt at odds. And so how can you get to principally to the same answers you did before, form over substance? So I think that people are struggling with that because of that notion. I think I would recommend that we make sure we're careful around talking about customers, because I think I just became aware of the speech gap from the SEC as far as implied customers. I think if we're talking about start being so far reaching, that might be a little harder to apply as far as like a lot of people are Microsoft's customers in some aspect. And so how far out do you need to go? And I think I would encourage us to look at what do you want the answer to be, or what do you think the answer should be? And then kind of walk back from there. I think it's also interesting, just in my perspective, it was anti-abuse because people thought they wanted more revenue. Most people actually in a company want rev adjust versus OpEx because OpEx is more controlled. And so it's easier to, if you bring in $1 of revenue to have $1 of decrease of revenue, it's easier to manage that way versus if you bring in $1 of revenue, a lot of times people say you get like 20% of cost, you can spend 20% of that as OpEx. And so I think a lot of times people just stop and say, oh, great, I can get to a revenue adjustment, I'm done. So I just would encourage us to look at what do we want the principle to be.
Okay, great. Thank you everyone for the great discussion this morning. We're right on time, 2 minutes over. So we're going great. We're going to break for lunch. We're coming back at 12:45.
Yes.
Right, so we'll be back at 12:45. Lunch is out this door. And if you need any direction from anyone, just let us know. So back at 12:45. Thank you. All right. Thank you everyone for joining us again this afternoon. I think we had a great discussion this morning. We left off on principal agent. I thought we got some good ideas there and some good dialogue. I'm going to turn over to Adam, who's going to continue our discussion on topic 3 with the next set of issues.
All right. Thank you so much, Mary. So in addition to the areas that were highlighted by Jennifer a bit earlier in the discussion, we've heard from stakeholders that the guidance related to licensing, identifying performance obligations, determining standalone selling price or SSP, the constraint on variable consideration, and sales-based or usage-based royalties each resulted in challenges during the implementation of Topic 606. For this section, I'll plan to just briefly highlight some of the challenges faced by stakeholders within these areas and provide some of the FASB staff's considerations. I'll start with licensing, determining standalone selling price, and identifying performance obligations, given that these areas have some degree of overlap in regards to their challenges. So starting with licensing, stakeholders told us that it can be difficult to determine whether a license is distinct from other services provided in a contract. So for example, whether an on-premises software license is distinct from cloud-based services in an arrangement. In particular, stakeholders told us that determining whether the license and other services are distinct in the context of the contract can be challenging, especially when considering whether the license and other services are highly interdependent and highly interrelated. Oftentimes, these arrangements may result in the identification of multiple performance obligations, with the license revenue recognized at a point in time when the entity can use and benefit from that license, and the service revenue recognized over time. Stakeholders also observed that additional complexities can arise when determining the transaction price and allocating the transaction price across multiple performance obligations. Next, I'll move to the standalone selling price. We heard from stakeholders that determining the standalone selling price of distinct goods or services can be challenging, particularly in arrangements with multiple performance obligations where the entity does not separately sell the individual goods or services. In those instances, an entity would be required to estimate the SSP of the separate goods or services, which may require a high degree of judgment. This challenge could occur in multiple types of arrangements. However, going back to my earlier example, it is a challenge that is often seen when an entity identifies a software license and related cloud-based services as two distinct performance obligations, but the entity does not separately sell either the license or the cloud-based services individually. The staff thinks that the root cause of some of these challenges result from certain fundamental aspects of the guidance on identifying performance obligations. Specifically, Topic 606 defines a performance obligation and provides certain criteria and factors for identifying those obligations, which are based on the notion of distinct goods and services. When a contract includes more than one good or service, an entity must assess whether each good or service is distinct, including whether they are distinct in the context of the contract. This assessment requires a significant amount of judgment and can be particularly challenging for complex and evolving arrangements, which is often the case in arrangements involving technology products and services. In addition, the staff notes that there are certain differences between Topic 606 and Topic 605 that may have resulted in the identification of additional performance obligations under the new revenue guidance, as compared to what would have been recognized under the legacy revenue guidance. For example, the notion of a performance obligation in Topic 606 is similar to the notion of a deliverable under Topic 605. However, that term was never defined under the legacy revenue guidance, and therefore some entities and industries may identify a greater number of performance obligations than were previously identified in similar revenue arrangements. Further, the staff notes that the previous revenue guidance on the licenses of IP was limited and industry specific, which resulted in accounting diversity. Therefore, the implementation of Topic 606 may have changed existing accounting practice for certain entities. Lastly, the staff notes that Topic 606 removed the concepts of vendor-specific objective evidence and the contingent revenue cap. These concepts may have historically resulted in a reduced number of performance obligations within an arrangement, or said differently, they may have reduced the need to separate the units of account within an arrangement, and therefore the need to allocate the transaction price. The next challenging area that we heard about from stakeholders is the constraint on variable consideration. Stakeholders noted that it can be challenging to conclude that variable consideration should be fully constrained even for transactions with long durations and high uncertainty. Topic 606 requires an entity to include in the transaction price some or all of an amount of variable consideration to the extent that it is probable that a significant reversal of the amount of cumulative revenue recognized will not occur. Furthermore, the guidance includes factors to consider when determining whether to constrain the amount of variable consideration, including whether the consideration is highly susceptible to factors outside of the entity's influence and whether the uncertainty is not expected to be resolved for a long period of time. The staff thinks that the challenges in this area were largely the result of fundamental differences in the implementation between Topic 606 and the legacy revenue guidance in Topic 605. A fundamental principle of the new revenue standard is that revenue should be recognized in an amount that reflects the consideration that an entity expects to receive for transferred goods or services. Therefore, under topic 606, the estimation of certain transaction prices that contain variable consideration can be inherently difficult and require significant judgment. However, due to the contingent revenue cap and the legacy revenue guidance, variable or contingent revenue was generally not recognized until the contingency was resolved and the fees were fixed and determinable. The last challenging implementation area that I would like to just quickly highlight relates to the sales-based or usage-based royalty exception. For this area, stakeholders have told us that the expected benefits of the sales-based or usage-based royalty exception is lessened when a contract includes 2 performance obligations, and only one of those is a license subject to the exception. In these instances, an entity would still be required to estimate the future consideration in order to allocate a portion of the transaction price to the component of the contract that is not subject to the exception. Additionally, stakeholders have also expressed support for expanding the sales-based or usage-based royalty exception beyond licenses of IP to other economically similar arrangements. For example, the sale of IP or software as a service that is priced based on usage. So, with that background on these different areas, we'd now like to ask participants question 8 in the handout, which is, do you have any feedback on the implementation challenges identified here? Additionally, do you think any of these challenges require further action by the board? And if so, do you have any suggested solutions or actions for the board to consider or feedback for prioritization? And with that, I'll turn it over to participants for discussion.
Yeah, thanks, Adam. I know we've teed up a lot there all at once, but as Adam mentioned, there's a lot of overlap between the various areas. So I guess whoever wants to start us off can set what we're going to start with. I see Stacy's got her flag up, so you can kick us off here.
I mean, I figured that was pretty obvious. I feel like it was written towards us, but I have a lot of feedback on licensing, but maybe not new, right? And I think it's just, so I think I would kind of bifurcate it of, these are a lot of the conversations that were had during the standard setting process. And so I understand when you're creating a model that's principles based, it's meant to be for every industry. You've got to give up certain things that maybe are industry specific. The way that software companies contract is different than most other industries because there's very little cost outside of R&D. And so the way that people contract might be just different. When you use the words the SOE, I was like, had an emotional reaction of, I will give up almost anything to not have to deal with that again. And so I think it's a good reminder for all of us of the things that we left behind. And so there's, some of the stuff is just traded, right? So we don't have to deal with that, but now we have to deal with judgment for a standalone selling price. So I would say in general, I think we knew that licensing was going to be treated differently and there were going to be more rules-based, and we were expecting that. We expected it to be hard. It is. When you're doing things like modifications and renewals guidance, once you already kind of bifurcated from principles and you're in a set of rules, it does make it hard in new business models to know how to apply principles because it's difficult. I would say standalone selling price absolutely is because we get to identify more things than we did before. I'm happy that we get to identify more things than we did before. And so I think it's, when I'm talking about the benefits and the costs, I think those are costs that are justified generally. I think when you start to identify things that start not making sense to have to identify all these separate performance obligations, again, if you're in a subscription, again, software companies throw a lot of things in there because there's no cost. So we might throw in 50 things and we don't care if you use 5 of them or all 50. We just kind of know it's a different mix because it's easier just to sell a single subscription to people and let them pick and choose. That does make it more difficult when you're having to evaluate every single thing separately and you don't sell things. And especially if you don't have costs, there's not a cost tracking mechanism either. Or if someone's using a license, again, it's different than if you have a cost and you can say, okay, I know how many people are using that. If it's a license, you just don't know how many people are using that license functionality on premise. So again, I consider these things hard, but I wouldn't ask for anything differently. I think that might be surprising. I think term license is hard and has extra complexities. And unless you fundamentally change the standard principle to account for it differently, I don't know that there's any small tweaks that you can do at this point.
Sandy?
I won't reiterate the comments that Stacy made, but I will say that I've gotten very consistent feedback from some of our other software clients on those particular aspects as well. On determining SSP, in addition to, term-based licenses where PCS and the license itself is not sold separately, yes, we continue to see challenges on determining SSP. It becomes even harder for those companies that sell open source software. And then in terms of identifying performance obligations, this is really challenging in the tech industry. But I would point out that all companies are teching up. And so some of these challenges are new for a lot of these companies that traditionally have not been in tech. And so we spend a significant amount of time with our clients that maybe aren't as familiar with how practice has evolved in identifying performance obligations and educating them. And I would say in general, when it comes to things like on-prem software plus, whether it's critical PCS or a cloud-based service, that practice has evolved where it's a pretty high hurdle to getting to, highly interrelated and highly interdependent. And so I do think that this is a very challenging area for accountants to sort of maneuver through, because it does involve getting a very detailed understanding of the underlying technology. And I can say that there have been so many instances where we're talking to software engineers to really understand, what resides on the on-prem software versus the cloud-based service. And so, certainly continue to see a lot of challenges there. We also see a lot of challenges for companies that sell smart devices. And so devices, right? I mean, more and more are getting smart, right? Where there is an underlying cloud-based service. And so in addition to having those discussions related to whether or not there's sufficient functional interdependency to get to combining, I think we do have a lot of discussions with our clients related to one of the examples in the standard on equipment and consumables, where you have that functional interdependency. But at the same time, you also have to evaluate whether or not they can be fulfilled separately. And so I don't think it's necessarily intuitive to some of our clients that if you throw in a reseller or a distributor in the mix so that, some of the devices can be fulfilled separately, that you could potentially get to a much different answer, notwithstanding that functional interdependency. And so I do think that example related to equipment and consumables is a bit challenging for some companies to apply. And then variable consideration, a lot of companies do have pretty decent processes in place associated with it, but I do think that this will continue to be a challenging estimation process for some, especially when they're entering into new types of arrangements that they don't have historical data points for. So the estimation process there can continue to be challenging. Also figuring out whether the variable consideration allocation exception related to allocating variable consideration to one but not all distinct goods or services, is whether that's met, is also very challenging for companies, especially in terms of figuring out whether or not you meet the allocation objective. And so we see a lot of flavors of fixed fees, plus usage-based fees. And then, I think we do hear very consistent feedback in terms of what's in the materials, that it would be helpful to apply the royalty exception outside of licenses of IP. But I do think there could be challenges there in terms of if you're expanding it. It may be difficult to figure out, where to make the cut unless you just expand it broadly to all arrangements. And so at this point, I think I'm just going to reiterate what I said before. I don't think that, we should make any significant changes to the standard. I spoke a lot about identifying performance obligations. Yes, it's very challenging. I think we can make the appropriate judgments in those circumstances. And however, to the extent that there are emerging issues for new types of arrangements where people are asking for some level of clarifying guidance, I think addressing some of those issues on a narrow basis as, the FASB staff gets feedback on some of these new emerging issues that, companies are really struggling with, that, perhaps making some narrow improvements could be helpful. But again, I would say let's not disrupt practice in terms of the judgments that people are already making for the arrangements that exist today.
Angela?
Thanks, Mary. Maybe I'll keep it relatively high level. I'll just observe that as it relates to licensing, we talked earlier about not wanting accounting standards to dictate business decisions. I think, quite frankly, the difference in accounting between a term license and a subscription, a SaaS arrangement, is one of those areas where, quite frankly, we see companies trying to structure to get to an accounting answer that they want. And often that's smaller companies, but nonetheless, that is one of the areas, one of the few, to be fair, with the standard where we do see structuring opportunities, people playing with things like term, return rights, pricing, right? Just how can they shift from a point in time to an overtime model? Beyond that, I think the areas that we struggle with the most, or that we see clients struggling with the most, related to licensing. And then this is an overlap with identification performance obligations and some variable consideration as well. But the difference between a usage-based fee that is really a discrete number of usage cases versus a stand ready obligation and its variable consideration, that dichotomy can be challenging. The assessment of distinct, I think we mentioned that already. In particular, we see companies trying to, maybe I'll call it, push the boundary a bit on when the subsequent updates are really integral to the original license. We've got the antivirus example in the standard. That's sort of an obvious end of the spectrum. Where do you fall within, how far down that do you go before they become distinct? And then again, just the term, what is the term versus the contract term, how do return rights or cancellation options impact the timing of revenue, and it can be significantly different in those cases. Moving on to the identification of performance obligations, I think one of the areas, and Sandy mentioned this earlier, the equipment and consumables example is challenging. I think generally speaking, and this is a high level generalization, what we find is that the examples within the standard, from a client viewpoint, it's sometimes difficult to understand why the different fact patterns ended up in different conclusions, in particular around distinct in the context of the contract. It's hard to discern the underlying principle underneath those examples, right? We look at one that may end up with distinct, and we look at another one that may end up with not distinct, and the client says, well, what's the difference, right? It's just hard sometimes to distinguish that. I think part of the problem with identifying performance obligations as well is this question of, well, do I look at it from the company's viewpoint? Do I look at it from the customer's viewpoint? The equipment and consumables, well, from the customer's viewpoint, do they really want the razor without the razor blades? Well, no, right? Well, but from the company's standpoint, they're distinct. And so that's challenging, especially when part of the performance obligation guidance does require you to think about it from the customer's viewpoint. For example, implicit promises, right? It's just hard to understand exactly how to think about that. We do find, quite frankly, that the vast majority of the time, when the companies get to the wrong answer, it's because they've misidentified performance obligations. This continues to be, to me, the most important step in the process, and the one where people often struggle. As specifically as it relates to SSP, maybe an observation, we are challenged with how narrowly maybe observable is defined. There was a comment in the paper about the fact that people tend to focus on observable selling prices, even if the historical prices might not be consistent. But I think that's because the standard requires you to start with an observable price. And so trying to come off of that can be challenging. It's also can be challenging. We see occasionally where a client may have standard price lists, but they never really sell anything on a standalone basis. So it's like, well, but now, and again, is it hard to support that that's SSP? No, it's just another cost, right? I've got to go think about it every year. I've got to go document it. I've got to audit it, right? All of those fun things. The one I want to focus a little more on is the constraint on variable consideration. There's a comment in paragraph 42 that just says that there may be some hesitancy or reluctance to apply those factors. I will tell you, in my experience, there is zero hesitancy. Every client would love to apply those and say, I'm going to constrain my revenue 100%. The problem is that those are not criterion, that if one's met, that means that it is not probable or even rebuttable presumptions. It says you need to think about whether there's a constraint, and these are area or times when it might be not probable. So the struggle is supporting why the existence of those factors make it not probable, and then being able to audit that. I'll give you a quick example. We had a client that performed services on a contingency fee basis, and it related to benefits through the VA. And so when you looked at it, each individual customer, the outcome was highly susceptible or highly dependent upon the VA's decisions. They weren't necessarily, at least superficially, one might not be predictive of the other. They were all individual people and that kind of thing. And so you might look at those factors and say, well, clearly this is not probable, right? There's a constraint there. The flip side of that was that they touted in their investor relations information their acceptance rate and how often they got to a positive outcome and that they could predict. Well, okay, well then those are contradictory factors. Just because you meet those criterion doesn't necessarily mean that 100% of your revenue is fully constrained. And so that's from an audit perspective, the challenge that we have is getting a client to support that, and then being able to audit that support is really challenging. The last thing I might mention, and this isn't specific to the sales or usage-based royalties exception necessarily, but we would be open to some private company practical expedients related to variable consideration. We've mentioned expanding the use of the sales and usage-based royalty exception. Certainly happy to think about that as well, but we can envision, especially for private companies, that trying to estimate and document their estimation of variable consideration can be really super challenging. So whether it's an expansion to other types of variable consideration or just a practical expedient, we'd be interested in pursuing that, or at least thinking about it more.
Allison?
To try to just add incremental comments, I had mentioned at the outset that within our national office that identifying performance obligations is a frequent topic and one that often advances to pre-clearance for public companies. More specifically, the higher proportion of performance obligation questions involve licenses of IP, specifically software licenses for on-premise software, as well as SaaS being combined together. And I would reiterate all of the points that Sandy made on this. I won't repeat them, but would agree with everything that she observed there. I would note that there was an issue that was identified a few years ago around modifying licenses of intellectual property that had advanced to be an EITF paper or an EITF issue that has been subsumed into the PIR, and I'm kind of hoping that we don't lose track of it. But to the extent that we do, as the paper notes, diversity exists. There's a lot of documentation in the firm books about different methods that could be acceptable for accounting for licenses of IP. So to the extent that practice is okay with that existing in firm books, then great. But to the extent that it's not, that's an opportunity to perhaps pick that issue back up and continue to work on it. The only other comment that I'll make that's incremental to what folks mentioned already, because I would agree with observations on some of the others, relates to on the variable consideration point, maybe building on what Angela said, that we frequently are, in our experience, similar to what she said, companies want to constrain 100%. It's more practical and more conservative. And from an auditor's perspective, we are educating our audit teams that even though it is easier to audit and there's less risk associated with it, that's not actually the accounting model, that you're supposed to be thinking through, is there a minimum amount of the variable consideration that should be recognized? The question that we will ask our clients is there really no expectation of any amount of revenue? Like you really have no idea. You really think there's nothing you're going to get out of this contract until it gets resolved. And that can then advance the conversations a little bit further, where companies do need to think about minimum amounts, and also observing that the point in time when uncertainty is resolved from variable consideration might not be immediately at the point when the uncertainty is resolved, because you're trying to assess the effect, the likelihood and magnitude, and comparing it to cumulative revenue recognized. So the magnitude certainly decreases as revenue is being recognized. And so helping companies to understand that and our audit teams to understand that is an education exercise. Is there anything to be done about any of this? Maybe just to go back on licenses of IP, the only solution to help with some of the complexity there would be for term-based licenses of software to be recognized over time. appreciate that that's a fundamental change to the standard. So I'm not advocating for that, but that's just an observation that that would be a way to solve that problem, perhaps also respond to some investor feedback.
Mark?
Yep, thank you. You know, getting a lot out of these discussions and understanding the complexities that the preparers face in dealing with some of these issues. It seems like from an investor standpoint, I mean, it's pretty clear that that results in variability. And in my opinion, that's an argument for greater disclosure, which I think would be really helpful as an investor to understand what happened in a given quarter. And I think there are some, you know, critical data points that wouldn't be very hard to disclose and would be extremely helpful. As an example, mandating on disaggregation, how much of the revenue recorded in the quarter was recognized upfront at a point in time versus over time. That's, I think, very limited in terms of the number of companies that give that. And that would tell you a lot about the decisions the companies made about how they're allocating total deal value. I would say providing information on, just as a standard practice, the percentage of typical deal value recognized upfront, not only the actual numbers of what was recognized in the quarter, but what's their policy on a typical term deal? How much do they recognize upfront? Some companies do that, some don't. It makes it really challenging to understand the moving parts under GAAP revenue. Average deal duration, which is probably more of a reach, but that would be very helpful. In terms of variable consideration, I think this is becoming a bigger issue as more and more software companies move to consumption-based models. And my suspicion is there's a lot more of it that's being recognized. And I would imagine there's a lot of discretion involved. And there's almost no disclosure. And I mean, if that's one big want I would have that I think is going to be a bigger issue going forward, is quantifying the amount of variable consideration that was included in GAAP revenue for a period, I think would be valuable. And in terms of performance obligations, this is, again, probably a reach, but the one-year expedient is applied across the software space, not all companies, but I think a material percentage. And it takes away the informational value of that metric. And I mean, I would much prefer to kind of eliminate that expedient and have companies that are more of a kind of turns-based model just say it's immaterial, like apply the materiality threshold instead of allowing software companies to apply the one-year expedient that I don't think was really designed for those types of models.
Doug?
Yeah, thanks. A lot of really good stuff being said here. Just kind of want to maybe add on to some things that we've already heard, particularly from a private company preparer perspective. Maybe anecdotally too, from a licensing perspective, a previous hat I wore dealt a lot in the VSOE space, and I reiterate the sentiment there that that's like the worst of the four-letter words. So getting rid of that, bravo. But yeah, sales and usage-based royalty exemption for licensing, and obviously as a franchisor, is huge for us. I definitely understand the complexity and challenges where if you've got multiple performance obligations that don't fit that model, still having to allocate. I can only speak for my enterprise. I think generally we would argue it's one performance obligation because the license and the other services are sort of tangled together. And so I imagine many companies that have the opportunity to apply that exception often argue that it's just one performance obligation. But I think that kind of speaks to the complexity of identifying performance obligations in contracts. And I think I heard a comment that that's the most important part of this model and arguably some of the most challenging. But I do think the sales and usage-based royalty exemption provides a lot of simplification for companies that fit into that. And if there's an opportunity to potentially expand the use of that, while that may be difficult to set guardrails around, could be an opportunity to help create some simplification there. So I would reiterate that potential. As far as identifying performance obligations, it's interesting because I think, as was talked about earlier under previous GAAP, if you didn't fall into certain industry guidance, there was really no, pointable rev rec guidance that you were going to. And so I think a lot of companies didn't even realize they had multiple element arrangements when in reality they did. And when 606 came on, it was now everyone's having to do this identification of performance obligations when they weren't even thinking about deliverables or components under previous GAAP. And so I think the complexity there is it is complex, determining what distinct means and separately identifiable and in doing so from the vantage point of the customer is just inherently a really challenging thing. And it's particularly so for companies that maybe don't have the longevity of applying that. When it comes to standard setting in that place, I think I recognize the difficulty of creating additional standard setting to help with that. Though I would acknowledge that is a big hurdle, particularly for private companies, even to document their considerations around. So I don't know how much help I'm providing by just acknowledging that it is difficult, and I don't know how to solve for that in the most effective way. Standalone selling price is a similar thing, though it's interesting there too, because for particularly companies, when you have these emerging transactions, and it's okay, well, my company has no history of selling or providing this service, so I have nothing to point to. So now you're going to, okay, well, what exists in the market? Well, we're a very unique company. So there's not, so am I making adjustments to market prices, or am I doing some sort of cost plus? What I appreciate in the guidance is that there are options there, and it sort of says, hey, you're not limited. I think that's a good thing. You're not quantitatively forced into a VSOE type analysis, and you kind of have that I guess luxury to determine standalone selling price at a little bit more freedom. Though I think there was an acknowledgement in the materials that if you weren't using one of those sort of 3 recommended approaches, even though the guidance says these are just 3, you can consider more. If you're trying to deviate from that, the difficulty of getting that through your auditors in terms of how you applied that, right, wrong, or indifferent. I think a lot of companies are like, here's the contract pricing. How can I substantiate that that's materially consistent with SSP? Like I said, I think we invariably are like, well, when we price this, we were taking into account like the cost associated with doing that service, and we wanted to make a reasonable margin. And it's more of just like a prove out exercise that contract pricing is. And so I think private companies or companies in general may be just sort of figuring out ways to take the spirit of the guidance and almost document their way that contract pricing may. But I do think there's probably opportunities there for simplification. And then I love all the conversation around constraint on variable consideration and the challenges there. I think that in the notes that I took, it's like, it's either all or none sort of mentality, and this sort of like minimum. It starts to get really complex when you talk about probability of what's the, if am I really going to get no revenue here? If it's subject to contingency, I think the natural reaction is like constrain it all, and until it's certain that we're going to get it. And I would say that in most cases, I don't feel like we've gotten a ton of pushback on those approaches, even though we know we're not maybe in the full spirit of what the standard sort of requires. And so I think there was some discussion around potential practical expedience for private companies in the area of variable consideration. I would completely be on board with helping think through that. And as a PCC member, I think that's something that we should lean into, because I think there's certainly some opportunity there. Yeah, that's it.
Alex?
Thank you. I'll probably mention first the software term licenses, and this was an old EITF issue, and I think was also a special task force related to this. At this point in time, probably consistent with what some of the other people said, hard to imagine wholesale changes in the model, which this one would be. Plus, I don't really know how you would conceptually separate overtime recognition of term licenses with other licenses where upfront recognition makes sense. It's kind of was like an embedded conflict that came from previous guidance between, the movie licenses and the software licenses, and sort of, maybe not surprisingly, Hollywood beat out Silicon Valley in this regard. So we went with the old movie revenue recognition upfront, which I think makes sense, and I don't know how to change it in the best way. On the point about would the accounting change or impact the business terms? So I've had a number of discussions with finance executives over time, and they were saying, well, what can we think about? How can we change our contracts to recognize these term licenses over time? And, you can always say, well, introduce cancellation clauses, let's say 3-month notice cancellation clause, and it's very easy. And I've actually not seen one company follow this advice because they're always afraid to lose customers. I don't know rightly or wrongly, but that's what I've observed. I know one public company that did reduce their contract terms from like 5 years to 1 year, but I've not seen anybody go down to like quarterly. So that's on the term licenses. The next one, you know, on the standalone selling prices, somebody just said, you know, it's becoming more difficult for people to apply methods outside of the three directly in the guidance, and we've certainly seen this sort of reduction of the number of methods or diversity of the methods used, and coupled with the increase on the focus on the quality of those estimates. Now, with this said, in terms of the numbers companies produce, actually, there is quite a bit of diversity that I've seen, and sometimes actually on the quality side may not really be particularly high. And so when companies go through this effort and come up with highly subjective numbers, you kind of wonder, is this really adding value in terms of the numbers the investors see? You know, the favorite example I had was somebody was judging that the value of the license was 20% license, 20% of the total deal. And they said, well, look at Oracle financial statements, public company, say their revenues, their license revenues for that year were 2 billion and their support revenue for that year were 8 billion. Great support. Makes no sense, but nonetheless, I've seen this, and actually that has been in the audited financial or support for the audited financial statements. So quality can be very on and off in those. How to improve this, how to change this, again, very hard to say. Another issue somebody mentioned is the nature of the performance obligation. I think specifically differentiating between variable consideration versus optional goods and services. And what probably one of the most practical challenges we see in with various companies. So this can be applicable to cloud companies. This can be applicable in other industries as well. Like if you have stand ready, is this a single performance obligation with variable consideration? Or should this not be looked at as stand ready, but instead some minimum volume and then optional purchases above and beyond this? Actually, either way you look at this, this can be causing challenges with estimating, recognizing revenue if you have a blend of fixed fee, and especially if the fixed fee is sort of like not really the same amount in every period. And then if you have a variable fee, and especially if the variable fee kicks in at various points in time, like the minimum is different in different years. So then you can't really go around estimating the variable consideration. You can't apply the practical expedient of recognize as earned. And then the challenges with estimation of variable consideration come in. Now, the other observation I'll make is, and this is related more to deals where there is significant license element, is the use of the residual method. What we've seen over time is, you know, when you apply the residual method for estimating standalone selling price, you have to meet certain conditions, one of which is that everything else in the deal has to be observable. So I think in earlier years, we've seen relatively more relaxed application, and companies were saying, well, we can use the residual method. I think more recently, the bar seems to have been raised in terms of when you can apply the residual method, and probably appropriately so, because it's hard to get to observable for everything else in a lot of those deals. But that's actually in terms of what could be changed. I wonder if there may be a relaxation of the bar to apply the residual method in certain situations, if that might make sense. Otherwise, in terms of things that could be done, you know, Angela mentioned practical expedience, and that may be something that might make sense, and not just simply for private companies, but even generally. This could be a way of allowing companies to have a little bit more sort of easier way around certain aspects of 606 without changing significantly the entire framework. You know, one example we were thinking about is when you have a contract that is going to go for 1 year or less, and the recognition of a performance obligation is over time, or a particular performance obligation is over time, would it make sense to have a practical expedient to go straight line, for example? Yeah, it may move numbers between the quarters, but most of the time it probably will not move them significantly, and or movements between different quarters will offset each other. So that could be an example. You know, there's a couple of practical expedients dealing with contracts where certain aspects are limited to 1 year or less. So that could kind of fit in within this particular framework. Thank you.
Susan?
Thank you. I'll be super quick because Angela already teed up the major implementation issue that we're seeing that's listed here in the document. And I think if Allison's working on principal agent questions, I'm working on identifying performance obligations questions as much as she is. So if I can pinpoint where the confusion is coming, I think, or a majority of the confusion is which perspective are you supposed to be looking from, if any, and identifying if a promise is distinct in the context of the contract. And of course, companies, many companies, not all, are looking and saying, oh, it is absolutely the customer perspective. And the customer wants one thing, a solution, a combined offering. And we all know how I love the use of that word solution. So it's one thing always, otherwise they wouldn't have bought those three things. They would have just, only bought one of those things. And it's hard to argue with that. And it's not completely unfounded either. You see in the TRG papers, I think it's 9 and 11, if you look at the summaries, there's a lot of discussion about summarizing how the TRG members were really confused on which perspective to look at. And of course, we got the gift of 2016-10, but it didn't really clarify which perspective, if any, you're supposed to look from. We do see in the standard that it requires looking and considering the customer's perspective for immaterial promises in the contract, and there's sections for control transfer, but it's not in that I've seen step 2. So for me, it's not standard setting. I think education and maybe a clarification. I'm not even sure everyone in this room agrees on that perspective of who it is from, or if not at all, or if it's simply just looking at the factors and indicators in 25-21. So I think that would be really helpful.
Stacy, is your tent from earlier, or did you have some? Okay, go. Then the floor is yours.
Hey, that's what happens when you go first. You're like, yes, I want to provide clarity. So I think a couple things. I think I'll focus on specifically on licenses. Yes, Allison, as far as could you make a choice to go back and say all term licenses are ratable? I think the way you would do that is say time does not, or time matters. And so it either matters or it doesn't. I would say I wouldn't push for it. I think it's a wholesale change, but I would say just from my perspective, there would be a pretty large upfront cost. And then I think there's relief over time. So, I don't know if you're going to find someone who says, yes, please give me this upfront cost right now, but there is that balance. I would say, I think that there's some narrow scoped things like, for instance, around identifying performance obligations, and is it one thing versus multiple things? That might be an area to explore more, because if there's a lot of cost in, pulling apart things and people are saying it's one thing, so could we explore something around that? I would say, I think customer perspective, or like what perspective are you looking at, matters. I think the whole like interdependency and one has to impact the other, that's really technically very hard. I've spent a ton of time with engineers on that. And then when we go, I found the easier way to look at things is marketing, as far as how do you market it to the end customer. I understand there's a thing around solution. I'll give 2 examples. One, we sell a bundle. It's called my M365. It's Office, it's Windows, it's EMS. It's one solution, but a customer knows they're getting things individually, and we're packaging it like, get this and get it for a discount. I think about that differently than Office 365, which is a customer goes, great, I can use, I can collaborate real time. I can move it from my phone to my computer. They don't know that in the background, we had to download bits. We use cloud services, you know what I mean? So it's really around the how you get it there versus like what a customer thinks they're buying. And I think, we've pivoted our analysis on that. So I don't know if that's something to explore more. It's easier for people to understand that than it is to talk to 1,000 engineers.
Brent?
Well, I'll gratuitously mention that our industry had asked for overtime recognition on license IP as well, but I wouldn't recommend changing that at this point. And I wanted to follow up on something Allison mentioned. It would have helped out with that EITF issue that wasn't resolved. And I saw in the materials that the perception is that the issue has sort of gone away. For my company, it largely has for the moment. It's conceivable someday it could come back. It was challenging to deal with those issues. We ended up doing, I guess, what we thought was the most conservative approach, not necessarily maybe the best approach, but given the lack of clarity, that was kind of the direction we went. I'm curious that my perception was it was a much bigger issue for the software companies that were switching from licensing to SaaS. So I suppose if it's not important to them anymore, then you're probably right to think that maybe it's not worth resurrecting that EITF issue.
Stacy.
I would say it is actually important to software companies. I think maybe what I would add is, I think if you look at a company like Microsoft, we have a ton of resources. And so we have to spend a lot of time thinking about theoretically right thing to do. And so we have a lot of judgment. We have a lot of, I would say, high-level experts looking at contracts. When I look across the industry, I think a couple of things are happening. I think one, people are moving from on-premise to cloud, but you don't do that necessarily overnight. Sometimes you take it from on-premise, perpetual, you take it to a term license because someone's saying, I don't want to commit and buy this huge thing up front. So you're like, let me just give it to you for a period of time. And then you're finding too, is that they're not just going all cloud, they are doing a hybrid nature. So I do think it is relevant to the software industry still. And I think especially in this time of transition, I think I thought before too was like, hey, this is short-term pain because we're going to go all cloud and then we're not going to worry about this anymore. And that just hasn't materialized. So I think it's here for a while.
Jim?
Brent kind of answered this, but I think Allison brought up one thing to address licensing would be to change software licensing to be over time. But I suspect if we were to do that, I do remember, Brent, your industry was very interested in all licensing over time. So if we were to open it up for software, I don't know why others wouldn't say, well, you should open that up for us. And I do remember, and that would have been my preferred approach. In fact, I think the vote predates me, but 7-0 at the FASB for overtime for all licenses. And I think it was 14-0 at the ISB to do all license, 13-0, whatever the number was, 13-1. Mark knows. To do all licenses up front. And then we ended up with this hybrid model. So, and I think everybody at the outset talked about, well, one of the biggest benefits was a converged solution. So I do wonder how we think about if we were to do anything on licenses. My suspicion would be the ISB might be 13-1 or whatever the number would be to do all up front if they were to change, and we'd be 7-0 or something like that to do. And whether we could actually address, so it's an intellectually interesting discussion, but I think the whole problem at the time was, are you transferring something over time? To Stacy's point, does time matter or does time not? And I think you can kind of debate that endlessly. So I would be interested if we were to do something, would people be thinking that should be limited to software, and sort of if so, why? And I think Brent already answered their preference would have been all, but not looking for a change now.
Tomo?
I'll be quick. Regarding SSP, one of the challenges we're facing is where there's a wide range of reasonable SSP. And, I think there was a reference to just pointing to a observable selling price when that reasonable range includes the observable selling price. We tend to point to that because that's much easier to defend. But I think when there is a wide range, it is a challenge from our perspective. And but I would not change guidance. It does allow for a lot of flexibility and judgment. I would not change that. In terms of the constraint on variable consideration, I don't think it's a standard issue, but it's more of a, how do you apply the definition of probable? I think there's a general understanding. People would generally understand what that means. But when you apply to certain standards, the thresholds tend to change, right? Whether it's recognizing revenue or being able to apply hedge accounting, the threshold probability, the percentage seems to be higher when you apply it. If you apply that term to another standard, it seems to be lower. So I think that's some of the challenges we're seeing.
Allison?
So just to respond, Jim, to your observation around licenses more broadly, and I'm glad you brought up the compromise that happened with point in time versus over time. And, certainly as I try to think about licenses, we've got technology industry, we've got life sciences, media and entertainment, retail consumer products. My recollection is that there were some industries that were very much in favor for overtime, but maybe others can correct me if I'm misremembering this, like within the media and entertainment space, wasn't it the music subsector within media and entertainment was more interested in the point in time? So moving to something that would be overtime for all licenses would likely not be welcomed by all folks who have licenses of IP. So it really becomes at that point, I think, a question of investors and what their interest is from a financial statement usage perspective and also costs. But I do think that doing that would take some costs out of the system with respect to identifying performance obligations. When you have these two things with a point in time license and an overtime software component, that issue goes away, or at least the pressure on that. So the costs in the system go down. Modifications of licenses of IP, that issue kind of goes away too. So it solves a lot of problems, but probably not everybody is going to agree that they would want to do it just because it would be a change. Certainly from a life sciences perspective, and Stephen can speak to this a little bit more, I'm sure, but we frequently see licenses of IP in the life sciences space combined with R&D, in particular for earlier stage companies, of which we audit a number of them. So that's another industry where we do, in contrast with technology, where we see separate performance obligations, we tend to see the license and the services at least combined together into a single performance obligation. So another data point sort of pointing towards maybe overtime recognition. The majority of fact sets might work for that, but again, investors and preparers might not be uniform on that.
David?
I mean, I don't have a strong opinion about almost like any of these point in time, overtime, this type of thing. What if it changed or if it stays? To be perfectly honest, it's about the bridge to understanding what's there. And if you can separate out the revenue to the deferred revenue or the receivable for each one, then I think we can understand it. And that could take a lot of judgment out of all of this stuff. And you could just do whatever is easiest if we can reconcile these pieces back. And then that's the information that we're kind of struggling for right now. So it's about that bridge is what I really want. And everything else on the judgments that are over there, I can bridge and make at least understand what's going on, because it's not perfect on one side, it's not perfect on the other. But if you're spending a lot of financial reporting time on judgments that you could bridge through, a little bit more disaggregation, that's what I would look for.
Great. So I don't see any other hands up. Just before we move on to the next set of topics, anyone want to get in? Okay. Okay, I'm going to turn it over to Jennifer to tee up the last three issues.
Okay, thank you everyone for your feedback so far. The last three topics are incremental costs of obtaining a contract, short cycle manufacturing, and disclosures. And the introduction of more comprehensive guidance on both incremental costs to obtain a contract and on disclosures led to changes in many companies' financial statements, at a minimum in the area of disclosure. So I'll talk about each of these three areas. First, on incremental costs, stakeholders have told us that it can be difficult to identify which costs should be capitalized and to determine the appropriate amortization period for capitalized costs. The staff notes that for some, just having to capitalize these costs was a significant change from previous guidance, in which a policy election was allowed to just go ahead and expense them. So various questions related to this topic were also explored by the TRG in two separate memos. Moving on to short cycle manufacturing. So stakeholders have noted for short cycle manufacturing entities, the guidance on determining whether a performance obligation is satisfied over time or at a point in time can be difficult to apply. We've heard that applying this guidance to those types of contracts results in a pattern of revenue recognition that is often different from how management views its transactions. These entities typically conclude under 606 that revenue must be recognized over time because the products do not have an alternative use and the entity has an enforceable right to payment. But by contrast, most short cycle manufacturers recognize revenue at the point in time that products were shipped under 605. The staff notes that this is one consequence of eliminating multiple industry-specific models, as we've discussed before, and consistent with the moving towards a more cohesive and consistent approach for all industries. And so, finally, disclosure. This has come up quite a bit today, and so we've already gotten some great feedback on it. But I think to kind of bring it all together, for many companies, disclosures was the biggest area of change, and in some cases, this was the only change to the financial statements. Most investors, as we've heard, find the new disclosures to be informative, or especially disclosures about disaggregated revenue and remaining performance obligations. Some investors have even suggested that disclosures be expanded to cover additional metrics. FASB staff research shows that the disaggregation of revenue disclosures has increased when compared to the previous revenue guidance, thereby providing more information. However, the extent of incremental disaggregation does depend on various factors, such as the level of disaggregation provided before the new standard, and even the entity's size. And I think that's a theme that's been coming up throughout all of these topics today. So with that background on each of the last three topics, we'll turn back to question 8 and open it up for your feedback.
Pat?
So I guess on the incremental cost to obtain a contract, I mean, I sort of feel like that's maybe collateral damage that, causes more problems than it solves. Like, I think in retrospect, we'd have been fine if people just kept doing whatever they were doing with commissions and the like. I don't know if other people feel strongly about that, but especially when you start dealing with like the renewal commissions and as a commensurate, all that kind of stuff, it seems like friction, and I'm not really sure how much people care. It feels like some attempt at matching, which you think isn't really all that important given all the other cost guidance that's, due costs when they're costs. On the disclosure point, I think overall, clearly, an improvement, an enhancement. I think there is still quite a bit of diversity in terms of how well people really articulate their revenue, how they recognize revenue, what it really means. But in particular on the disaggregated revenue, some of the things we've talked about in terms of like the investor's need for the bridge, really understanding what's driving that. And that may just be the reality of trying to deal with the disclosure principle, but I think there's definitely an opportunity for improvement when it comes to the disaggregated disclosures. And I guess the only specific observation I had is when you look at the principle around, disaggregate the revenue by the way in which the nature, timing, and amount of cash flows are affected. The principle behind recognizing revenue is really the entity's performance, which doesn't, by definition, necessarily correlate to when they're entitled to cash for those things. So I guess the question is, do you want it to be focused on the nature of the entity's activities to generate the revenue, or the ways in which they're ultimately entitled to get cash from their customers? So just some observations in terms of where I see some challenges.
David?
I think with the incremental cost, I mean, this is kind of my stance on every intangible asset. Just expense it and tell me disaggregate it. Those would be the information. I think we could get the same amount of information that we get from it now. There might be a matching thing, but that's a really hard thing to do anyway. So if I just understand what you're investing in your sales, or what you're investing in your sales team, or investing in your commissions, that's the information that I really want. I don't like financial reporting time spent on amortization periods or impairments of these types of assets. I'd rather that be spent on different disaggregation going through. And on the last thing, from the income statement, it's more about, for me, the nature of the entity's ability to generate revenue. I have a cash flow statement for the different timings and things there. And the key to that analysis is becoming more and more of a problem, is being able to connect the three statements versus trying to make them into one. And if I can connect them, then I can understand the nature and risks about cash collection. But overall, when I'm looking at income statement metrics, I want it to be, what is the possibility of generation of this company? And then I can look at the timing of the cash receipts and contractual things that go in.
Mark?
Yeah, I think I'm saying the same thing that David's saying, but it's a little different, because the cost of obtaining a contract is, I think, very high value information. And I was going to initially say, I wish every company was required to break it out, to give you a roll forward, to tell you actually how much was put on the balance sheet. And I think the percentage that in the world of software is probably like half. But it tells you a lot about what happened in the business. So my concern about going David's route is, I mean, I don't want to lose the information because it's so valuable to me, I guess is what the companies before 606, I don't think gave you much, and they wouldn't break out commissions separately. And it tells you a lot, I think, about sales activity in a quarter. So I think the information is highly valuable. I wish it was more widely disclosed. And I agree that the amortization side doesn't tell me much about what happened in the quarter, since it reflects commissions paid over the last 3 to 5 years in the world of software. But what you kind of put on the balance sheet in a quarter tells you a lot. So I think it's great information, and I don't want to lose it. I wish there's more of it. So if it's not capitalized, I would still want to see it.
Meredith?
So on the cost to obtain a customer, that was certainly one of those kind of, I would say, outsized or surprised impacts at adoption, as far as the level of effort that was required to reach conclusions there. So I think there was a real heavy lift early on. I think if people are willing to live with diversity, that would be a great answer. But I think there are people who really want it capitalized, and there are people that want to expense those costs. On the short cycle manufacturing, I think that's one of those areas that we certainly saw companies making changes to their contracts to achieve an accounting result. And so certainly nothing you want to have happen as a result of standard setting, where a company is relinquishing some rights they have so that they can, achieve an accounting result. A lot of companies in that space will just, they're doing non-GAAP kind of how material is it kind of assessments, but that's a real challenge. But I'm not necessarily advocating for a change to the standard overall.
Sandy?
Yeah, and I would say similarly on these 3 areas, while certainly there are challenges, I likewise would not suggest any amendments to the standard at this point. I was thinking about some of the comments that David had made in terms of, the amount of work that goes into it and whether or not it is relevant, and also appreciating Mark's comments that, this is relevant information. But when I think about all the mental gymnastics that we go through in practice, in addition to, sales commissions, which certainly is challenging in many respects, we are starting to get a lot more questions outside of traditional sales commissions. And so we are encountering more and more issues with respect to scoping. And so we do have a lot of interpretive guidance on dealing with sales commissions, but what if those incremental costs are being incurred for other reasons? And what we're seeing is some amount of diversity here in terms of what's in or out. And one example I could give are app store fees. There's a lot of diversity in how people account for it, and for some companies that is material. And then, I know it wasn't in the write-up, but we also do get a lot of questions related to cost to fulfill a contract. Especially the condition that relates to whether costs generate or enhance resources of the entity. And so I think, cost to fulfill a contract in many ways, we have a lot of pre-existing practice with respect to certain types of contracts, like, construction contracts, et cetera. But, we are seeing other types of fact patterns where we're starting to see some diversity in views. And so, for example, like if you have assets that were technically transferred to the customer, but it's still needed by the entity to provide some sort of service, whether it's a cloud-based service or some other type of service, we do get a lot of questions here, and certainly have heard diversity in views. And so I just maybe wanted to highlight that sort of beyond your normal sales commissions type questions, there are other challenging questions that we're dealing with where there is diversity in views and diversity in practice in terms of what should be capitalized versus not.
Stephen?
Just on disaggregated revenue, I think one thing that's useful is that we often use as investors some of the parts analysis. So, you know, being able to disaggregate revenue and allow investors to attribute valuation on different parts of the business. So that's just something I would just like to add.
Jim?
Sorry, and the team's probably going to roll their eyes because I can't hear short cycle manufacturing without saying something. And I know I'm beating, I shouldn't even, PETA says you're not supposed to use that term, so I won't. But I do wonder the extent to which particularly private companies are even aware, because it's such a fundamental change to recognizing revenue. You know, I think before people would have viewed this sort of as bill and hold, and now it's required. And I do wonder if people are just doing back of the envelope calculations to conclude it's immaterial, which I think we heard. Others, I suspect, are missing it. Whether this is to put on your list, and I've brought this up before, but another good issue for the PCC to look into, whether there's some, I would do an expedient for all, but if we don't do that, whether this is something that could help private companies not have to go through calculations of immaterial items only to pass those on to, you know, audit committees and those charged with governance to say, well, the standard didn't make an impact. And so it sounds like a great, at least, issue to potentially explore an expedient to me. But if private companies are getting it right, that's fine too.
Angela?
Jim read my mind. I was just gonna, maybe two things, but starting with that one, just make an observation that this, for a lot of our private companies, the contract manufacturers of the world, they didn't adopt the standard until you get to year end. So they left their systems in place because management doesn't view this as an overtime deliverable, right? Or promise. They think of it as point in time shipments, and they continue to account for it on a point in time basis until we come into audit. And then they do some work to figure out what that stub period or that transition, right, looks like. And they put an entry on the balance sheet to reflect the and P&L to reflect any revenue for work in process, basically. So they're not really doing it. They're getting it right because we make them, basically, but they're not doing it on a day-to-day basis. So we actually would support at least considering or pursuing the possibility of a private company practical expedient. You could come in different flavors, but one easy one is just to say that the overtime, you could elect not to apply the overtime guidance and default to point in time. And we think that would be well received by some of our private company clients. The other point I just wanted to echo and reemphasize Sandy's comments about cost to fulfill. That is a challenging piece of literature as well.
Melissa?
Yeah, I'm just going to agree with Angela on the short cycle manufacturing. I mean, most of our clients are saying that it accelerates revenue when it doesn't make sense to them and they don't know why they have to do it. And a lot of them are doing that back of the napkin at the end of the year. Let me see how material this is and I'll record it if it's really material. And then they have contract terms, and then they're trying to argue, well, you know what, this contract term, we would never actually really enforce it. If we canceled this contract, we would never actually make them pay cost plus margin. So I think a practical expedient would be really helpful here.
Doug?
As the PCC guy in the room, I'm just going to make a call on when we're calling it a practical expedient, if the practical expedient is to allow point in time versus overtime, would that really be a practical expedient, or would it be an accounting alternative? And I just want to because I want to respect what we're talking about here too, to take it back to the PCC, but the threshold for accounting alternative, if you get a different recognition and measurement answer is a little bit different. So I just want to make sure when we say practical expedient, I'm under, because I don't have a ton of short cycle manufacturing experience. I just want to make sure I'm understanding that.
Christine?
I guess I haven't heard from many users as to whether they care or not. And I don't know if there's anybody in the room today that has an answer for me today, but I think that's something that we would also want to put in the mix, is just understanding whether this matters to users. If it doesn't, then that makes it an easy decision.
Yeah, no, that's a great point. I think it goes back to what Doug's saying, is if it's a accounting alternative, you have to say there's a difference in relevance to users. Whereas if it's a practical expedient, you're just more quickly getting to the same spots. That's a great point, Christine. Mark?
Yeah, I just want to say one more thing about cost of obtaining a contract. In my work, I would say that's a more valuable metric than RPOs, billings, bookings, even the year-over-year change in GAAP revenue. It's critical. So it's interesting that I know it's a hassle to provide it, but I would say I think it gives such great information. That's why I wish there was more disclosure about it, because again, it's so telling about how much incremental business these software companies generate each quarter. And if they're ratable models, you're not necessarily going to see the impact of that gross new business elsewhere in the GAAP financials.
Stacy?
Since you asked for just a prepare view, we have a very small amount that's in the short cycle manufacturing. I would agree. I put it in the category if it doesn't make intuitive sense, we do it out of compliance. But it's one that we don't look at that way internally. We have to always bridge back and say, this is what it means, right? If we were to ship it. The other thing actually on the cost of commissions, it also, because there are some practical expedients around what is in there and what's not in there, you're actually not getting a full picture. So I'm just wondering if like the disaggregated expenses, right, would actually give more meaningful information if you said, what's all of the selling costs that you have, not just what is, capitalizable. I think that's what you were kind of making a point, David, earlier about, is you want that information, but maybe if it's disaggregated versus just on the balance sheet.
Yeah, I mean, I generally, the stance on that is if anybody thinks they want to put another asset on the balance sheet, then that's important enough to segregate out on the income statement, and we can probably get to the same or maybe a better ballpark, because then you don't have to rely on amortization and that kind of stuff, but you can have something which is key to holding. You can create a metric, this investment to sales, and you can have judgment in it, and you can at least ask questions to try and get companies are motivated to be accurate about something like that. You don't want to put too much in because you're not getting a return. You don't want to put too little in because you're not investing in your company. And so I like those type of metrics that you can track like that. And the disaggregation, I think Mark talked about it, but yeah, I definitely want the information. And I think that concept I know Mark seems to be more software, but that concept is what I want across. Like, it doesn't have to be commissions. It's more in this investment in your company's future, not current sales, not current expenses, future investment, and having that disaggregated.
Alex?
Sorry. So on the concept of short-term manufacturing and the practical expedience potential discussed there. So going from overtime to point in time at the end is a change in recognition method, but that's where actually, the previous idea I mentioned of allowing companies to elect to go straight line if it's short-term, that actually wouldn't change the way it's recognized, but it would take a pain away out of estimating where exactly you are, and would be much easier for companies to understand, to digest, and to present to their users as well. So just wanted to mention.
Angela, is your flag from before, or are you?
No, it's new.
Okay,
I'm just going to, this isn't horribly profound, but to Doug's question, I guess I looked at that type of an option as very, very similar to the franchisor practical expedient. Quite frankly, personally, I would have called that a measurement alternative, but we called it a practical expedient, but I don't think it's different in concept. It's allowing a private company to take a shortcut, so to speak, to get to something that's quite frankly, probably a similar outcome.
Eric?
I just want to reiterate what Sandy and I think Angela brought up. I do think cost to fulfill a contract is a challenging aspect of the literature, particularly with respect to the requirement, which is fairly very highly principles based, and that is what is a cost to generate or enhance a resource. It's very hard to explain what that is and what it's referring to. Thanks.
Okay, great. I think we're going to move on to, oh, sorry, Toma.
Thank you. I think I agree with what David and Stacy mentioned about, the visibility, transparency that we can achieve through more disclosure versus putting on the balance sheet and spending a lot of time trying to, prove out and assess the life, et cetera. So going back to some of the implementation costs, I think this is something where we could achieve the transparency while reducing implementation costs.
Thank you. So we're going to move on to topic 4 just before I do any last comments on topic 3. I don't see any hands. Oh, sorry, Angela.
Just real quick, and stop me if we're going to talk about this later, but there was question 9 was just, are there any other pervasive issues? So just a couple that I will maybe mention. One is just the interaction between this standard and other standards. I think Susan may talk at some point about the interaction between 606 and 718. So I won't. Well, I think we were moving on past section 3. Yeah. So I wanted, I knew we had some thoughts, so I wanted to stop. So just the interaction between 606 and 718, anytime you've got equity involved. And even as simple as, am I granting equity to my customer, or am I selling stock along with a revenue contract, right? When do you draw that line? Although there are a lot more complexities. The interaction between the implicit price concession guidance and the bad debt guidance, right? At what point, if I've got an ongoing relationship, have I accepted a price concession versus I've just given up and I may take less only to collect what I can, but the rest is really bad debt and I don't want to spend legal fees. Let's be honest. One that I would encourage the staff, and is this a high priority? No. Is it low hanging fruit? Yes. Loss contracts. The fact that we still have guidance that requires a company to look at the scope of 60535. Wow. Getting rid of that and or doing something different to me would be beneficial. Trying to explain to companies that they've got to think about whether or not they would have been a construction contractor is challenging. I think that's something you could easily move into something that is a broader statement that is more aligned with IFRS, quite frankly, is the way I would go personally. But and then we've already talked about cost to fulfill, so that's it.
Allison?
So not really as much an implementation challenge as a current application challenge would be contract modifications. It was on my list of the 3 things that I mentioned are frequent topics of consultation. Specifically, instances when you're seeing partial terminations of contracts. That happens not infrequently, especially in this economic environment. And the contract modification guidance would seem to apply based on how it's described in the standard. And when there is a partial termination of a contract, frequently that is accompanied by a payment from the counterparty, the customer in the arrangement. And companies intuitively think that they should be recognizing revenue for that at that point in time. But the contract modification guidance would suggest otherwise in instances where what you're actually providing after the date of the change is distinct, which is a lot of contracts, things are distinct. So taking that termination payment and recognizing it in the future as the remaining goods and services are provided is not intuitive to companies. And so we spend a lot of time in discussion on that. So just for completeness, I wanted to add that to the record. Thank you.
Susan?
Thank you. And thanks, Angela, for keeping me honest there. I wanted to second Eric, Wes, and Sandy's comment on 34040 25.5B. So we spend a lot of time looking at that guidance. The cost, and it says you have to capitalize. The cost must generate or enhance resources at the entity that will be used in satisfying or continuing to satisfy performance obligations in the future. And then if you look down to 25.8, it's costs that you have to expense, costs that relate to satisfied performance obligations or partially satisfied performance obligations. So we spend so much time looking at those combined performance obligations where there has been equipment delivered up front, and it's a one performance obligation, a combined solution of the equipment, and then a monitoring service. So that is a really challenging area, and I'm not quite sure that where practice has gotten to is actually reflective of what's in the standard. So I really think it would be beneficial to that we take a second look at that. The other thing that I really wanted to mention, thank you, Angela, is equity payments, namely warrants, between vendors and customers. And this is top on our list right now. It has been so challenging to deal with these types of arrangements as they continue to gain popularity throughout practice. And it's because companies are trying to conserve cash, or you have really powerful vendors that are demanding payment in equity, in warrants versus cash. So they continue to pop up. I won't spend time on the 718-606 one where the vendor is issuing incentives to a customer to in the form of warrants to incentivize, because there's a fabulous agenda request sitting in the
on our website if anybody wants to read it.
In the board's inbox. So refer to that one because hopefully it very clearly explains the issue and proposed solutions. What I will spend time on is something that we've been talking to the staff about and other large firms about, is non-cash consideration received from a customer where the warrants vest based on future performance. And this really gets challenging when the company doesn't think that it will actually vest in 100% of the warrants. So where you have a clash is between the financial instruments folks and the 606 folks. And of course, the financial instruments folks think that it should be put on the balance sheet, and there's an appropriate way to value that warrant, that even if it's subject to vesting conditions, that you've still received it. I'm trying to get myself into a financial instruments mindset, which I don't really have. But then you talk to the 606 folks, and those folks see something that's in the scope of 606, and you should be layering on the constraint guidance and conserving that down and thinking about the vesting. Jim is going to set me straight shortly, I see. But so there is this disconnect with those types of arrangements, and we're seeing quite a bit of diversity in practice out there today. And those two separate paths lead to very different accounting results. So hopefully we can get some clarity on those very popular transactions.
Go ahead, Jim, did you?
Well, I have a view on the issue, and I think the question is it a derivative? And if so, when? I would say 606 has no impact on that. I think if those were derivatives, they were derivatives since 133 was issued. I hadn't seen practice ever account for that transaction as a derivative until very recently. And my view would have been, I would have never answered it that way, but I'm one person. I do note that we have a project on the definition of a derivative, and I think this would be squarely in the scope of certain of the alternatives. But I think for decades since the issuance of 133, those were not answered as derivatives.
And Susan, I would mention that I think we're going to be coming back to the board here in the next couple of months on definition of a derivative to see if the board wants to add that to the technical agenda and what the scope of those solutions would be. So stay tuned on that one.
Awesome. I think we should just take it as a win. Jim said it's not a derivative, so let's move on.
Well, I would point out I have one view and don't have a vested interest in the answer, but I do know for decades that those had not been accounted for as derivatives. If they are, there are an awful lot of errors in practice.
Stacy?
Yep. So my catch-all is really on the intersectionality of 606 and 842. I actually think, so I do love the principles generally in 606, and I think there's a couple areas in which get scoped out. Specifically, if you have a lease part, right, you don't actually include that part in your RPO. And I think that's actually counterintuitive. If we have a big dedicated data center or something for someone, and we have a long-term contract, we would not actually put that in RPO. I think people would expect that it would be in RPO. The second one, I think that's easier to address. The second one actually is when we have a dedicated or customized servers because someone says, I want Azure, but I want it to always be on, or I want it extra secure. The way in which we have to do that is dedicate it or modify it. And that gets scoped into leasing guidance. And then again, I'm bifurcating something that's a cloud service and I'm recognizing a big chunk up front, which is counterintuitive. And I'm thinking that if we actually could apply is this distinct within the context of the contract first? And if that, again, is that hardware gets in, it's one thing with the software and the services, and then it keeps within 606. I think that actually probably addresses the RPO issue as well. But I think you're going to see more of this as we get smarter devices where more people come into this license guidance and they're saying, is this license distinct from the hardware?
Sandy?
Yep. So I wanted to expand on this intersection of 606 or interaction of 606 with other standards. In addition, I think to what folks have already mentioned, we see a lot of practice issues with respect to how 606 interacts with 460. We're seeing it a lot in the value-based healthcare space, but we also see it in other spaces as well. And so I think there are a lot of practice issues that, I think this is actually one area where narrow scope type of standard setting might be helpful, because for a lot of companies, it's not intuitive to account for certain types of indemnifications in the scope of 460. And we get into a lot of debates about whether or not it, meets the definition of indemnification. And if so, when are you guaranteeing your own future performance? And so when do you have an instance where you actually meet that scope exception? And there is diverse views out there. And so I think we're going to see more and more of these questions with respect to how 606 interacts with 460. And I do believe that this is another area where, in addition to what others mentioned, that perhaps, standard setting might be beneficial.
Great, thanks, Sandy. Any last comments on question 9 on other issues we haven't discussed yet today? Okay, with that, I'm going to turn it over to Luke, who's going to take us through the next issue.
Thanks, Mary. The purpose of topic 4 is to discuss the standard setting process related to our current revenue guidance and obtain feedback on potential improvements to that process. A little bit of brief history. The revenue project kicked off in 2002 as a joint project with both the FASB and IASB. Leading up to the standard, there was a discussion paper and 2 exposure drafts as part of the deliberations and redeliberations, with update 2014-09 being issued in May of 2014. As part of the standard setting process leading up to and directly following update 2014-09, we'd like to get your feedback on 3 areas in particular. First is setting and deferring the effective date. Second is exposure, re-exposure, and clarifying amendments. And then the third is the transition resource group. Details on all 3 of these areas are in the roundtable materials, but I'll give a brief tee up of each before we kick off the discussion. Starting with setting and deferring the effective date, update 2014-09 was issued with an effective date of December 15th, 2016 for public business entities. In August of 2015, the board decided to defer the effective date by 1 year to give entities more time before adopting the standard for the reasons described in the materials. During the pandemic in 2020, the board decided to further defer the effective date 1 year for entities who had not yet adopted the standard at that time. Next is exposure, re-exposure, and clarifying amendments. The board issued a discussion paper and those 2 exposure drafts, leading to the issuance of update 2014-09 to expose and re-expose the various aspects of the guidance as the project evolved based on stakeholder feedback. After the issuance of the standard in 2014, the board continued to be responsive to stakeholder feedback and issued clarifying amendments between 2016 and 2021, with the most significant amendments being issued in 2016, being the ones that some of the areas we've discussed today: principal versus agent considerations, identifying performance obligations and licensing, and the narrow scope improvements and practical expedience. As we've discussed, these are inherently challenging issues or challenging areas rather, and the amendments sought to add additional guidance to address those implementation challenges. Finally, the Transition Resource Group, the TRG. The TRG was formed in 2014 to support the implementation of the new guidance. They held 8 public meetings, including 6 joint meetings with the IASB, to discuss issues raised by stakeholders. The feedback received through the TRG played a role in the board's decision to issue the previously mentioned clarifying amendments, and also led to the staff issuing 60 educational memos and the revenue recognition implementation Q&A to aid in the implementation of the standard. For this part of the discussion, we're looking for your feedback on the overall effectiveness of the standard setting process, on the process improvements described in the materials, establishing effective dates, and any other suggestions you may have for improvements to the standard setting process. With that, I'll open the floor for discussion of questions 10, 11, and 12.
Allison?
First of all, I want to say I think the TRG was great. We did a great job. In all seriousness, though, as I was trying to think through the history on this, there was a discussion paper, 2 exposure drafts, then the final standard, then 3 specific ASUs, plus codification improvements along the way, lots of information. It is really, to me, at this stage in my being a member of the accounting profession, it's very profound how much effort was put into listening to stakeholders, being responsive to stakeholders, making changes. And I think it's a tremendous accomplishment for both the FASB and the IASB, in my personal opinion, as well as the accounting profession as a whole. Eric raised a point, I thought, earlier about, well, there's a lot of new guidance that came out after the standard was issued, and is there a better way to engage stakeholders earlier on? I don't know. That's a really interesting question. I kind of view it as it's a responsibility of everybody in the accounting profession, every single person, to figure out better ways to engage on the standard. And maybe just in hindsight, it wouldn't really have been possible. You've got a converged standard. You had 21 board members, all with independent opinions. When you count the ISB and the FASB, trying to get consensus on issues, it's kind of remarkable that it got done in the first place, if I'm being perfectly honest. My key point, besides saying that I think it was a job well done by the standard setters, is that an important aspect of the standard setting process is the ongoing maintenance of that standard. And so a lot of the issues that we've talked about today could lend themselves to ongoing maintenance of the standard. And that's just an important ingredient, and want to make sure that that doesn't get lost in the shuffle. Thank you.
Pat?
Yeah, maybe just to echo Allison's positive feedback on just the overall process and getting the standard out. The TRG, I think, was hugely valuable, but I also agree with that last point that, yes, there's a level of intensity that probably makes sense during implementation, but I don't think it should end necessarily, right? I think there's ongoing implementation. We've certainly continued to have lots of discussions at the profession, continued discussion, sort of more ad hoc. I know there's a lot of reference to the technical inquiry process, but maybe not necessarily in TRG fashion, but better sort of broad socialization of some of those ongoing implementation discussions, I think would be helpful for everyone's benefit, and maybe would, minimize the need for all the firms to have very lengthy books. I just think it should be viewed less sort of episodically and more as a consistent program, just with maybe lesser intensity after the initial implementation.
Angela?
Yeah, a couple of thoughts. One, maybe just to piggyback off that, we do think it would be helpful to continue to have some forum for talking about some of these emerging issues, right, as the world evolves. Open to suggestions of what that might look like. Is it a TRG light? Is it an advisory group? Is it, we continue to think, quite frankly, the EITF is underutilized. Is it piggybacking off of them as a feedback loop? We just think there's value in that. As it relates more generally to the process that the board went through, I will, just reiterate the importance of the TRG process. Having been heavily involved, as some of the others were in the ASCPA industry focused groups, the board and staff support for that, I think, was really important. That was something the board didn't manage necessarily, but I think it was pretty critical. Some of the industries getting through the guidance originally. The last thing I'll maybe mention, and I say this acknowledging that in between adopting 606 by all entities and adopting 842 by all entities, we had this thing called COVID. But I do think it's helpful to the extent we can. The last question talks about effective dates. To the extent we can set an appropriate effective date implementation for private companies and stick with it and not defer it, that's helpful. I can't tell you how many calls we got from private companies wanting to know when the next deferral of 842 was coming, because we had deferred both of those so many times. Again, I say that with full awareness of why, but I think to the extent we can avoid that, that's just helpful.
Meredith?
Yeah, I would echo all the positive comments about the standard setting and the result. As far as the TRG, there, maybe you could pull it forward, some, but then there's this balance you have that if preparers feel that it's still kind of in flux, then they're not putting pen to paper, and you kind of need them to put pen to paper to actually come up with some of the challenges, right? And so that was probably the biggest challenge of this. It's such a huge standard to get companies to know what they don't know, to go ahead and get in there, start doing some of the analysis. I think that's why we kind of had these deferrals, which ended up being necessary. I think for a standard this large, I think generally you wouldn't want a PIR effective date to be that long and to have that many deferrals, but I thought it was necessary. I would say some of the educational materials that the FASB put out, like the Q&A, I thought that is really helpful. I would say do that earlier. I think early on it was challenging with all of the TRG discussions. You have a lot of papers out there, and you have the SEC saying, we want you to follow TRG guidance. And then it was like, well, what's the TRG guidance? Let me go find the minutes. So that was really helpful. I'd say continue to do that, providing that kind of educational kind of feedback and digestible information. That was really helpful.
Stacy? Yep, I think I have similar feedback, but I just want to make sure it's, I say it, is I think this is one of the best processes. I mean, it was for having something that was so impactful, or that you're taking one standard that's principles based. I think if you said this, 20 years ago, that you were going to have everyone following one principles based standard, people probably wouldn't have believed it. I think the number of issues that's around the table, the fact that we can talk about it in a few hours is, I think, a testament to the fact that the issues were vetted out. I also don't know that you could have actually got people involved earlier on, because until you actually make it real and you have a date and a deadline, you're not going to actually get people to pen to paper. And I agree. And so sometimes what's the right answer, to just continue to defer it versus like set a date out here? If you set a date out that's further out, I don't think you're getting people. I wouldn't have probably started as early as I did. So I think we had the right process, because I think the deferrals actually were a reflection of listening of, okay, this is actually really hard. And I look at things of like general concern versus specific. I think people are generally concerned, but until you put pen to paper, you don't have the specifics. And so I don't think you can make a decision around when the effective date is until you know the specifics.
Sandy?
Yes, so I won't reiterate what others said, other than, I do think that the TRG was extremely effective. And I agree that changing the process with Cecil was an improvement. We are going to continue to see challenges, right, in applying the guidance. And while I don't want to see significant changes to 606, I think generally speaking, it works really well. But, you are going to have people that are going to want clarifying guidance. And so I think it would be a great idea for the board and the staff to be very close to what those emerging practice issues are, whether it's, putting together another TRG or utilizing the EITF more. I think, having practitioners and preparers, et cetera, that are close to the practice issues would be helpful. So I do think that somebody like the EITF or the TRG might be more responsive in being able to address what those practice issues are, and whether or not, narrow improvements might be warranted.
Monique?
Thank you. I think Sandy took most of what I was going to say there, so which is great. But just echoing again everything that positive that folks said about the process, I thought it was great. The TRG was critical. I think for working some of the areas I work in, emerging tech and so forth, just working out how that gets met in a way that everybody can access, because it's going on, but a lot of it's going on in smaller groups, and for the broader preparer community, making sure they can get access to what we're all talking about.
David?
the other things seem like really good things, but I don't really have specific comments, but it's just about the effective date. If there's a way that we can piecemeal some of these really huge changes and they can come through the financial statements, it would be really beneficial to investors. And I think there's been a little bit of a feeling that some of these deferrals went through because people weren't doing initial steps that they could have been doing while the public companies were going live. And obviously we had COVID in there, but now we have a lease standard with very different interest rates that makes them almost non-comparable between public and private. So the window of a year makes sense in having that, but if we could get some sort of piecemeal, or they can put the disclosures in there that, we've identified step one here, we've been through, we know what the different deliverables we have are. We haven't been through all of the steps, or we have identified what our leases are. They don't change under the new one. We still have a lot of more work to do, but some way that we can keep companies accountable step by step for these huge changes. But it's hard because these were really huge changes, and hopefully foresee them to be that big in the future.
Doug?
Yeah, again, I would reiterate and agree with a lot of what everyone said. I think, again, private company prepare here, I really focus in on the deferrals and the appreciation for the FASB and recognizing the need, particularly, I think, and I'm going to get my dates wrong, but the standard that came out that directly addressed head on, like the differentiation of a public company new standard release date and private company release date, and intentionally building in a buffer there. I think probably a learning from these bigger standards like RevRec and leasing and CECL. And the reality is that private companies often rely on our public company comparables to help pave the way for us. And so we can go steal your disclosures and then just put our name in them. And so, so giving us plenty of time to do that. It's funny, I think there was a response about just when you start incorporating deferrals, it's a hard balancing line of like hearing stakeholder feedback and acknowledging that there's a need for a deferral, but not continuing to let that string draw out. Eventually you've got, we got to put it in place. And I think the problem with that is I think, and I would acknowledge that private companies are probably more susceptible to this than publics, but like waiting for that next deferral and not doing what, arguably you could be doing to get ready. And then all of a sudden it's like, oh, we're actually not going to get a deferral. And now we've got a month to get this in place. So again, I think I would acknowledge and appreciate that the deferrals are a recognition of the complexity of the standard, but almost balancing that line really well can be tough. And I think CECL was a good example of like, hey guys, like this is coming, like start doing it, start getting ready. Like we've given you some deferrals. And I think people have learned from the heels of lease accounting that, hey, like you probably need to start doing that assessment. And also using CECL as an example, since we're in the midst of that right now, and some of the things that we're leveraging as we prepare for adoption are those FASB Q&As. My gosh, like, obviously the firm guides are always helpful, but whenever it comes directly from the FASB, I think that's just such a great, even though I'm on the PCC, I'm admittedly probably not as good about utilizing resources that are coming from the FASB. I think there's just a natural inclination to go straight to the big four books. And again, I think anytime earlier in the process and often to educate, and as concerns or issues are coming in, addressing those things head on, I think just does nothing but help the process. I think I covered everything that I want to cover. Thank you.
Chris?
Yeah, I just wanted to comment on the deferral process. I think it's a really beneficial, and obviously across the board, there's been a number of deferrals. There's always going to be a difference between when you put pen to paper and you actually start implementing. So for us, we had not expected 606 to require a large implementation effort, but once you start, all of these nuances start popping up, and I couldn't even imagine what it would be for some of these companies that were impacted even more. So I think that it would be, the worst plan is a plan that can't be changed. And so I just wanted to point out that deferral process should be a strong consideration, and it's almost a mandatory thing as you go through all of these standards. Otherwise, you'll end up with shortcuts in the implementation, which is probably the last thing we want to see. So I just want to commend the deferral, and I think I would hope that would continue to be a strong consideration for all standards as you move forward.
Brent?
So I like a good accountant, I want to dig into the weeds on one thing before I leave the call. But just to start with, I think the board took on plenty of feedback from stakeholders. So I don't think anybody could say that you didn't listen enough. The one thing that, and I know the board has grappled with this, and it goes to this, whatever the box on every standard that says this doesn't apply to immaterial items. And the one thing that if there's a cost to us of this standard, ironically, it's around the disclosures related to deferred revenues and unsatisfied performance obligations. And we don't use that information internally, at least not in that format. As best we can tell, we don't get any questions from our investors about it. And I suspect that it's maybe because of the nature of our business and investors' understanding of our business. But, the SEC has said, well, small dollar things can be material, but it's hard for qualitatively, but big dollar things can't be immaterial. And so we go through this process that nobody seems to be using these numbers. Seems like there needs to be a way to, and the only suggestion I have is if the standard doesn't say you can meet some objective, there's an objective of this disclosure, you can meet it in a reasonable way. Here's a suggested way, but if there's a better way, use the better way. And I realize that might leave too big of a loophole for people to jump through, but at least for us, this isn't, effective on this narrow item. I think it applies in other standards though as well.
Meredith?
Yes, I was going to make a suggestion. I'm not going to prejudge the outcome of the suggestion. I don't know. I haven't done it, but you received a ton of feedback and comment letters, and then we had the TRG process that was very helpful, but resulted in a number of amendments. And so looking at the comment letters and the comments that were received and how many of those comments showed up in the TRG process, and does that change? Is there anything in the way that we think about how we respond to the comments that we could modify the process or tweak a little bit? Or have we learned anything if we were to correlate the comments received initially to what we kind of dealt with through the TRG?
Christine?
I just had a question for the group on the interplay between the initial effective date and then the possibility of a deferral. Because I think when setting the effective date, we often try to come up with how long do we think it's going to take in total for a standard to be implemented. And so let's say we figure out, okay, we need to give folks 4 years. Are we better off setting an effective date of 2 years to get people going and stand ready to provide a deferral, or set the effective date for 4 years and then stand firm on no deferral? I guess my concern with either of those approaches is that sometimes things don't start moving until later in the process, and then instead of the standard taking the reasonable 4 years that we might all have agreed up front was about the right amount of time, it ends up taking 6 years. And in the meantime, investors are waiting. So any advice on that interplay between the initial effective date and potential deferrals?
Alex?
On this specific question, I don't know if there may be appetite for something like this, but I think one of the challenges with 606 was that every public company had to go through the process, other than maybe some emerging growth filers that had private company dates, but I wonder if it might make sense to sort of put them into different categories, maybe like, using SEC terminology, large accelerated filers all go this year, and then let's say next category, accelerated filers go next year, and then everybody else goes. With large adoption, everybody was constrained on the resources, both in terms of the people within the companies, in terms of the audit firms, in terms of consultants, like everybody was very constrained.
Rich?
Yeah, no, thank you. Very helpful discussion. Some of you may know we've received quite a bit of criticism about how long it takes us from when we add a project to our agenda to when we complete it. And most of that criticism has been around RevRec, leasing, and CECL. So I've listened to the discussion, and it sounds like everyone thought it was a good process. But I go back to that question. Did we just take too long? And if we did take too long, what part of the process drove that do you think we ought to really take a look at? And if you don't think we took too long, if you thought, hey, every standard has a story, this is why it took this long, maybe there's nothing. But just for us as we learn and go forward for the next standards we set.
Stacy?
It's a really great question. I think you get feedback when something goes well, but took longer, and you get feedback when you took short amount of time and it didn't go well, right? So I think everyone kind of depends on what it is. And so I would rather have a longer process that actually was well vetted. Could it have gotten the same results if it had been shorter? I don't know, because looking at the TRG, issues were being brought out all throughout the process, and at some point you had to kind of cut it off. I'm wondering if there's more reliance on, an industry group like CCR or something, someone, group of companies that are willing to go in and dig in first to give feedback around, we think it's going to take X number of years. And so that can go into your initial, kind of best guess, so best educated guess. I think when I was first asked, how long was this going to take, the revenue standard was going to take, and I said 3 to 5 years, which I think my boss at the time was like, you can't say that, that's too long, but that's actually how long it took. Because if you look at, someone who's closest to the details is going to say, I know what it's going to take to go code systems, come up with, positions, et cetera. And so I think maybe just getting a group of people that will volunteer to do that. Yeah.
Pat?
Yeah, I think certainly like the revenue standard is probably, somewhat of a unique example, right? It's a standard that affects businesses pervasively. There's a wide range of businesses. We went from sort of nothing to a comprehensive model. I mean, I do think if you go all the way back to the beginning, like there were some pretty radical exploratory models that, I think ultimately probably that wasn't very productive time. So I think that's just a challenge inherent in how do you define what is the problem? How are we trying to solve it? And I'm not sure there's a simple answer to that, right? That's the art of the standard setting. But I think you also have to separate the question into sort of the actual writing of the standard to the then, okay, we're in this kind of, we have a standard or model. Now we're getting feedback on maybe how that does or doesn't work. And, whether you split that up between, a really well done exposure draft and then a lot of feedback and a lot of redeliberation, or you push a little harder and put some pressure into the system to get people really focused on it. Because I do agree that you'll never really identify what matters until people really get into the details and try to figure it out. And so where in the process you really put that pressure in the system, and that's kind of back on the effective dates. I think that's a hard question too, because I personally feel like this extremely protracted implementation cycle is not really helpful for anybody. I mean, this is always going to be more challenging, more difficult than just status quo. But, if we believe it's an important standard and it helps, the financial reporting or the information that's being delivered to the investors, and we should push to get it done and deal with sort of some of the pain that's going to require.
On Zoom, we have Stephen.
Sorry, as an investor, the way it's set up is that a lot of funds have, industry specialists. So rather than, potentially comprehensive, standards, maybe it be geared towards certain industries. There's certainly more urgency in some industry to have more disclosure in particular areas. You know, so maybe that's an approach to focus on particular categories of, you know, companies, particularly industry. So,
Brent?
I was going to say basically the same thing Pat said, but yeah, when you're trying to write a rule that affects the most important line for every company in the world, every type of business, it's probably going to take longer. You know, to me, the question is, can we really measure the benefits? Because now there's this thing about there's a cost to investors of delay. And so, you know, those two things are, I think, two sides of the same coin. Well, what would the benefit have been if we had gotten this done faster? Or what was the cost of this delay? I think those are pretty nebulous concepts. If there was more substance around that, I think it might be easier to know the need for speed on some of this stuff.
Tomo?
I agree that this is a very important standard. So I think the cost of shortening and doing it wrong would have been significant, because if you reissue a new standard, it would cause confusions. And from a preparer perspective, new system implementation, having new process. So I would think that the process the FASB went through and considering the timeline was appropriate. Just also responding to Christine, your question, I think the implementation date should be a realistic date, because if it's a 2-year date, people would assume and expect a deferral. I think that will drive bad behavior. So I think, you know, setting a realistic date and then getting feedback is probably more meaningful for the board. Thank you.
Steve?
Thank you. When Stacy was at these meetings with me when we started this working group, and I look at the revenue standard very differently, I guess, how it impacted, as you said, Patrick. When I look at some of the things, there was existing guidance already in play that companies were using. So I look at this, it was already out there, and the practice has been deep rooted in many companies already in play. It impacted economics. It impacted contracts with customers already in play. And then, of course, it actually impacted the accounting. So having all those elements is reason why I think the time it needed to really go through, as you said, Stacy, really be vetted. And again, I don't want to talk DICE, but I see DICE being different. That to me is disclosure. And so to your question, Christine, like if I'm an investor, does it make sense to just show 1 year, or do I need to wait 3 years till I have information for the investor on this new format? See, that's a question. I don't know. So that's a great point of when you look at just disclosure or a revenue standard, which has such an impact and deep rooted on so many things at so many levels. So that's where I think it does impact the effective date and how we think about it. So I think I go through that kind of criteria in my own mind. But revenue by far, this was a culmination of standards that the FASB has written in many different ways for every different industry, and people were following this all along. So how do you kind of say, everybody, okay, stop what you're doing and let's come up with a new standard and forget about everything and start all over again? That took a lot of time. And I was in the room, and there was a lot of back and forth between software versus life sciences, manufacturing companies, media. Everyone had a different point of view of what they thought made sense, and to come up with a compromise that everybody could live with. So let's not forget that. And I've been in all those meetings, and it was really some tough discussions, but I think we got to a good place. When you get to just disclosure, then that's very different standard.
So we've got about 15 minutes left. I just want to do Sue and Chris have their cards up, and then we'll move on to the next topic. So go ahead, Sue.
I think this discussion of effective date is a very interesting one, and I take Stacy's comments on board. I think if I recollect the discussions as it relates to revenue, I think when we decided to think about deferring the standard, the quality of discussions with stakeholders about what their project plans were and how long it would take was tremendous. And somehow being, I know we can never get that exactly when we're developing the standard because everybody's sort of thinking about where's it going to land, but somewhere in between, I think could be really powerful. The discussions with private companies, I think, was much different. It was about the timing and trying to get them motivated to look at the standards, much like you said, Angela.
Chris?
Yeah, so the only thing I'd say is I doubt there was any preparers that were complaining about the time between, the time that it took to implement. And so I think there's probably a disconnect between what users want, which drives a lot of the standards, and the time that it takes for everybody, all the way down to the smallest company to the largest companies to implement, and they all have to do it. And there's all, they have to do it along with their day jobs. And even if you bring in consultants, they've got to get up to speed with the people on the premises to be able to go through all of the implementation. So, going back to your original question about the time, I don't think that, while the time may have seemed long and we may have needed deferrals to keep it going, I think the problem is there's probably a disconnect between the time that everybody has to do the work to get it done right and the user's expectation of, why can't I have this today? And there's probably just has to be a wider understanding of the actual costs that companies are going to have to incur and why it's going to take so long to do some of this stuff versus just having an easy button once something's issued.
Okay, great discussion on that topic. Stacey, did you have a final?
I just wanted to just quickly add, to my comment earlier about having a prepare group. I actually think when I was thinking about, we started hitting the ground running from day one. We were already coding systems, and I actually thinking, could you even bring in, system providers early in the conversation with the preparers too, to give some feedback into the system? Because I hear a lot from preparers saying the systems are not ready, the systems are not ready. And so the question would be, is there something that, an Oracle or SAP or others could be doing in the beginning so that way it does speed up the process?
Thanks. So now I'm going to turn it over to Luke, who's going to tee up our last topic. Oh, sorry, Josh. Sorry.
No, you're good. All right. So for the final topic, the post-implementation review process is part of the Financial Accounting Foundation's Board of Trustees oversight responsibilities for the FASB, and it assists the trustees in evaluating the effectiveness of the standard setting process by the FASB. So historically, this process has been conducted by the FAF. However, revenue is the first PIR to be conducted by the FASB staff. So the PIR process has three main objectives. The first of which is to determine whether a standard is accomplishing its stated purpose. Two is to evaluate whether the standard's implementation and continuing compliance is to evaluate the standard's implementation and continuing compliance cost-related benefits. And third is to provide feedback to improve the standard setting process. So these objectives are met through three stages. Stage one is the post-issuance date implementation monitoring. This is where the board actively monitors practice prior to the initial implementation and creates and distributes educational materials and implementation guidance. Stage two is the post-effective date evaluation of costs and benefits. And this is where the board assesses the benefits and costs of a standard to various stakeholders and monitors the ongoing application of the standard. Stage three is the summary of research and reporting, in which the board summarizes all of the research it's accumulated into a final report and describes the activities conducted and any actions taken to address any identified issues. So to this point in stage one, the board is assisted with the implementation of the revenue guidance through the transition resource group, which has been talked about frequently, and through educational materials. Additionally, the board has issued several updates, as mentioned as well earlier, to clarify the application of topic 606. In stage two, the staff interacted with a variety of stakeholders through advisory group meetings, discussions, surveys, and conferences, while also consulting with the IASB on their PIR process. So the ongoing activities within stage two relate to monitoring the application of the standard through technical inquiries, advisory group discussions, and through events such as this roundtable. So we expect to wrap up stage two and move into stage three next year. So for the final part of this discussion, we are looking for your feedback on any activities, outreach, or research that the board and staff has performed as part of the revenue PIR process, and whether there are any suggestions on improving the PIR process in general. So with that, I will turn it over to the participants to discuss questions 13 and 14.
And I think as we've gone through, we've heard some good suggestions that we've taken note of that cover up on this topic. I think some of the things about, continuous maintenance of the standard and making sure we stay on top of the issues that we discussed in topic three. So I'd say here we'd be looking for anything kind of incremental to what's already been discussed. So I think Pat's going to kick us off on this.
Sure. Thanks, Mary. So I think when you look at the description of the PIR process, it sounds to me pretty thorough and pretty ambitious. Obviously, I think it comes down to sort of the execution, the feedback of what the staff and the board have learned through these various interactions over the years. So maybe a little bit of it depends on what's in the final report, sort of what's the real kind of, okay, what did we learn and what do we plan to do going forward? Because I think it sounds like it has all the right elements in it to me. It's just sort of a question of like, was the rigor around how we identified costs and evaluated benefits sort of consistent, objective, comprehensive, inclusive, and then what did we learn from that we're going to incorporate into future standard setting?
Angela?
The only maybe feedback I'll give, and I understand as I say this out loud that it's challenging, is considering to think about how to get feedback from private companies. Understand again that they don't have the same resources as large public companies. We've obviously got the PCC, the Small Business Advisory Committee. There are some standing groups, but I'm wondering if some more targeted, proactive outreach might be helpful, and maybe the right place to start is not the companies themselves, but their service providers. Stacy mentioned talking to IT companies. On the private company side, maybe reaching out to some of the smaller accounting firms and or consulting firms who are down in the weeds working with those clients might be a good way to start.
David?
I mean, I don't think it's about the PIR process. I think it seems like it's really robust, but the biggest findings that I think come out of it are the ones that change behavior. And if there's a way to kind of front load those or understand the things that are going to change behavior that we didn't anticipate, or there wasn't an anticipation of that, I think that's the worst place we want to be, is an accounting answer that they're willing to spend money to change. I think that's a tough place to be, but I think everything else about the PIR process is really good. And I don't know what it was in one of the other sessions, but somebody had mentioned, and I thought Angela's idea, but asking questions maybe about awareness of new standards through CE questions might get a little bit more feedback from private companies.
Any final comments? Or Meredith?
Yeah, maybe just one more shout out for convergence. So I know you noted that the staff would continue to monitor the ISB's process, but I'd encourage, if appropriate, for there to be board level interaction, especially as the boards think about whether or not there's additional, targeted standard setting to do.
Okay, great. That's a good segue. Oh, sorry. Go ahead, Steve.
Just a question. I'm not sure. Maybe someone can answer, but how did this roll out even to folks like going into accounting, like education and universities and colleges? The cost of that and getting professors to understand the new rules, and did they learn this new change, and are they teaching this new accounting standard, especially revenue? Like, I'm not sure how it got taught. I'm curious. I guess it's a question, and I'm not sure, and what that impact would be, because these folks are going to become accounting majors, and they're eventually going to go into accounting as a major. So I'm just curious to see how it was implemented even down at the university level.
Yeah, and we don't have time for it, but I had told Luke and Joshua they could give testimonials about how they only know 606. So it's like they don't know the mess that was all these other industry specific. So I think we've got real life evidence. Okay, I think that's all the tense. So I think that concludes our discussion. I just wanted to share a little bit of info on next steps. So after this roundtable, we plan at some point next year to have a public board meeting to provide a PIR update to the board on all of the work performed to date. Our last update with the board was last year, so we'll bring them up in public on everything we've discussed today. We're going to continue to monitor revenue adoption, so our work is not done, including the challenging areas that we've discussed today and any further research that we might want to perform on those. those. And then we're continuing to monitor the ISB's process. We know that they're in the midst of their request for information on their PIR. We're very in touch with them on what they're hearing, sharing results of what we're hearing and what they're hearing. So we'll continue to monitor that. And again, I just want to thank everyone for your participation today. This was a really valuable input to the PIR process. And I think it was great to have everyone together to be able to share what your experience was and ideas for going forward. So I really want to take both those in person and on the Zoom. Thank you for taking the time today to share your feedback with us. And with that, I think we're concluded. All right, thank you.